What if the greatest investor in history has already handed you the blueprint to build generational wealth? Not in a secret vault, not in a private meeting with billionaires, but in plain sight through decades of shareholder letters, public speeches, and the meticulously documented actions of his company, Berkshire Hathaway. Warren Buffett's success is not a mystery reserved for the financial elite. It is a set of timeless, repeatable principles that any disciplined individual can learn and apply. Yet, Wall Street doesn't want you to know these secrets. They profit from your confusion, your short-term trading, your chase after the next hot stock. They thrive on complexity, while Buffett's genius lies in its elegant simplicity. In this 12-hour deep dive, we will expose the 7 core billionaire secrets that have allowed Warren Buffett to turn a modest investment partnership into a $900 billion empire. These are not get-rich-quick tricks or speculative gambles. They are fundamental laws of capital, human behavior, and long-term thinking that have been tested and proven across every market cycle for over 70 years. By the end of this journey, you will possess the same intellectual framework that has made Buffett a legend, and you will be equipped to navigate any market environment, from raging bull markets to devastating crashes, with confidence, discipline, and an unshakable focus on building real, lasting wealth. The first secret, the foundation upon which everything else is built, is the unbreakable law of the circle of competence. This is not about what you want to understand. It is about what you truly understand at a deep, fundamental level. Buffett has famously said, "You don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence." The size of that circle is not very important. Knowing its boundaries, however, is vital. Imagine your knowledge as a circle on a vast map of the global economy. Inside that circle are businesses whose products you use, whose economics you can model, whose competitive advantages you can see clearly. For Buffett, this circle included insurance, consumer brands like Coca-Cola and See's Candies, and railroads. He understood how they made money, what their costs were, and why customers kept coming back. Outside his circle were complex technology companies in the 1990s and early 2000s. He didn't pretend to understand them. He didn't chase their soaring stock prices during the dot-com bubble. He simply said, "I don't know," and stayed put. This is where most investors fail catastrophically. They see a sector booming, be it artificial intelligence, cryptocurrency, or biotech, and they feel FOMO, the fear of missing out. They dive in without truly understanding the underlying business, the technology, or the competitive landscape. They invest based on a narrative, a headline, or a tip from a friend. When the tide goes out, as it always does, they are left holding assets they never truly understood, and they panic sell at the worst possible time. Your first task as a serious investor is to draw your own circle of competence with ruthless honesty. Ask yourself, can I explain this company's business model to a 10-year-old? Can I predict with reasonable certainty how it will make money 5 or 10 years from now? Do I understand its main competitors and what would cause its moat, its competitive advantage, to erode? If you cannot answer yes to these questions, the company is outside your circle. And the rule is absolute. You do not invest outside your circle. This discipline is your ultimate defense against speculation and ruin. It forces you to slow down, to do the work, and to invest only where you have a genuine informational and analytical edge. It turns investing from a game of chance into a process of informed judgment. By focusing solely on what you know, you dramatically increase your odds of success and eliminate the single biggest source of permanent capital loss: ignorance. Building your circle is a lifelong process. You can expand it slowly by studying new industries, reading annual reports, and learning from experts, but you never, ever invest ahead of your knowledge. This is the first secret, the bedrock upon which all other Buffett principles are built. Without it, you are merely gambling. Without it, no amount of financial modeling or technical analysis can save you from making catastrophic errors that destroy decades of compounding in a single quarter. The circle of competence is not a limitation. It is your greatest source of power. It is the filter that separates intelligent speculation from reckless gambling. It is the boundary that protects your capital while you wait for opportunities within your domain of understanding. And in a world of infinite information and constant noise, This boundary is more valuable than any stock tip or market prediction you will ever receive. The second billionaire secret that Warren Buffett has mastered, and that Wall Street desperately hopes you never discover, is the relentless pursuit of economic moats. While brokers and analysts obsess over quarterly earnings reports and next year's growth projections, Buffett is laser-focused on one question that determines everything. What protects this business from competition 5, 10, 20 years from now? He borrowed this metaphor from medieval castles, where a moat of water surrounded the fortress, making it nearly impossible for invaders to breach the walls. In business, an economic moat is a durable, structural advantage that protects a company from its competitors and allows it to earn high returns on capital for a long period of time. Buffett's key insight, the one that separates him from 99% of investors, is this: a great business at a fair price is far superior to a fair business at a great price. A company with a wide, deep moat can compound its intrinsic value year after year, even if you overpay slightly for it initially. Conversely, a commodity business with no moat, a business that sells an undifferentiated product where the only competition is on price, is a terrible investment, no matter how cheap it appears. Its profits will inevitably be competed away. There are 5 primary types of powerful economic moats that Buffett hunts for with the precision of a master tracker. First, brand loyalty and pricing power. This is not about logos or advertising budgets. It is about the deep psychological connection between a product and its consumers that allows the company to raise prices consistently above inflation without losing market share. Think of Coca-Cola. People don't just buy a sugary drink. They buy a feeling, a memory, a global icon embedded in culture for over a century. This allows Coke to increase prices every single year, often by 3 to 5%, while maintaining or even growing volume. In periods of high inflation, this pricing power becomes a superpower. Coke can pass through cost increases to consumers while protecting its margins, something commodity businesses cannot do. Second, cost advantages that cannot be easily replicated. This occurs when a company can produce a good or service at a cost far lower than its rivals due to scale, proprietary technology, or unique access to resources. Geico, Berkshire's auto insurer, built its moat through a direct-to-consumer model that eliminated agent commissions, a structural cost advantage that competitors with legacy agent networks could not easily replicate without destroying their existing business models. Third, network effects, the phenomenon where a product or service becomes more valuable as more people use it. While Buffett was famously late to technology investments, his massive stake in Apple represents a recognition of one of the most powerful network effects in history: the Apple ecosystem. An iPhone user is not just buying a phone. They are buying entry into a walled garden of apps, services, payment systems, and hardware that creates immense switching costs. The more Apple products you own, the iPhone, the Mac, the iPad, the Apple Watch, the more valuable each additional product becomes, and the more painful it would be to leave the ecosystem entirely. Fourth, high switching costs that lock customers into long-term relationships. This is common in enterprise software, where a company like Oracle or Microsoft sells database systems or operating systems that become deeply embedded in a corporation's infrastructure. Once a bank or hospital integrates such a system into its daily operations, the cost, time, and risk of switching to a competitor become prohibitive, even if the competitor offers a slightly better product or lower price. The customer is effectively locked in for a decade or more. Fifth, regulatory licenses, patents, or other government-granted advantages that create legal barriers to competition. Think of utilities that operate as regulated monopolies in their service territories, or pharmaceutical companies holding exclusive patents on life-saving drugs. These moats are powerful but can be vulnerable to political change or patent expiration, so Buffett prefers moats built on consumer behavior and economics rather than government decree. When you analyze a potential investment, your primary question must shift from, "Is this stock cheap?" to "Where is the moat?" If you cannot identify a clear, durable, and defensible competitive advantage that will protect profits for at least 10 years, you must walk away, no matter how attractive the valuation appears. This secret shifts your entire perspective from financial engineering and accounting tricks to the fundamental economics of the business itself. It teaches you to think like an owner of a business who cares about its long-term survival and profitability, not a trader of a stock ticker who cares only about the next quarterly pop. Wall Street hates this secret because it undermines their entire business model of constant churn and short-term speculation. They cannot sell you hot stock tips if you are only buying businesses with decade-long competitive advantages. They cannot generate commissions if you hold stocks for 20 years instead of 20 days. This is why they will never teach you to look for moats. They profit from your ignorance of them. But once you internalize this secret, you will see the market differently forever. You will stop chasing yesterday's winners and start hunting for businesses that will still be dominating their industries when your grandchildren are born. You will understand why Buffett can sleep soundly while his portfolio contains companies facing temporary headwinds, because he knows their moats will protect them through any storm. The economic moat is not just an investment concept. It is a lens for understanding which businesses truly create value in our economy and which are merely riding temporary waves of popularity or low interest rates. Master this secret and you will never look at a stock quote the same way again. The third billionaire secret that Warren Buffett guards more carefully than any other, and the one that has saved his fortune multiple times when markets collapsed, is the sacred principle of margin of safety. This is not merely a valuation technique. It is a philosophy of risk management so profound that it transforms investing from a speculative gamble into a rational enterprise with asymmetric payoffs. The concept was inherited directly from Buffett's mentor, Benjamin Graham, the father of value investing, but Buffett refined it into the central pillar of his entire approach to capital allocation. At its core, the margin of safety is the difference between the price you pay for an asset and your conservative estimate of its intrinsic value. Intrinsic value itself is not a precise number. It is an estimate of the present value of all the cash a business will generate over its remaining life. Calculating it requires estimating future earnings, growth rates, competitive dynamics, and applying an appropriate discount rate to account for the time value of money and risk. Because the future is inherently uncertain, and because humans are systematically overconfident in their predictions, Buffett insists on using pessimistic, conservative assumptions in his intrinsic value calculations. He builds in buffers for things going wrong. A recession, a new competitor, regulatory changes, management mistakes, or simply his own errors in judgment. The margin of safety is your protection against these three inevitable realities: your own miscalculations, the unpredictable nature of the future, and the wild mood swings of the market that Graham personified as Mr. Market. If you calculate that a business is worth $100 per share based on conservative assumptions, you do not buy it at $99. You wait patiently for a price that offers a significant margin of safety, perhaps $70 or $60. This 30 to 40% discount provides a crucial cushion. If your estimates were too optimistic by 20%, you still break even. If the economy enters a severe recession that cuts earnings in half for 2 years, your downside is limited while your long-term upside remains intact. If a black swan event strikes the industry, your capital is protected from permanent impairment. Wall Street operates on the exact opposite principle. They buy stocks because they are going up, chasing momentum and paying ever higher prices based on hopes, dreams, and extrapolations of recent performance into infinity. They have no margin of safety. They justify rich valuations with phrases like, "This time is different," or "The old metrics don't apply to this new paradigm." When reality inevitably fails to meet their euphoric expectations, as it did in 2000, 2008, and will again, their investments collapse 50, 70, 90%, and they suffer permanent losses from which they never recover. For Buffett, buying without a margin of safety is not investing. It is speculating. It is gambling with your financial future and the future of your family. The margin of safety is what transformed him from a talented analyst into a legendary investor who preserved and grew capital through every major market crash of the last 70 years. It is the reason he could buy American Express in 1964 after the salad oil scandal destroyed its stock price, because he knew the brand and Traveler's Check franchise were worth far more than the panicked market price. It is why he invested $5 billion in Goldman Sachs' preferred stock in 2008 when the financial system appeared to be collapsing, because the terms gave him a 10% dividend yield plus warrants, creating an enormous margin of safety even in a worst-case scenario. It is why he has sat with record cash positions multiple times in Berkshire's history, waiting, sometimes for years, for prices that offer adequate margins of safety rather than deploying capital just to be fully invested. This secret demands a level of patience that most investors cannot muster. It means you will often sit on the sidelines while your friends and colleagues are getting rich in a mania. You will be called old-fashioned, boring, obsolete, a dinosaur who doesn't understand the new economy. In 1999, at the peak of the dot-com bubble, Buffett's performance lagged the S&P 500 by over 20 percentage points. Magazines ran cover stories asking, "What's wrong with Warren Buffett?" CNBC commentators declared value investing dead. He did not flinch. He did not abandon his principles to chase internet stocks he didn't understand. He waited, and when the bubble burst in 2000, the Nasdaq lost 78% of its value over 30 months. Companies like Pets.com, Webvan, and Boo.com vanished overnight. Investors who followed the hype lost everything. Buffett preserved capital, and then he deployed that capital at fire sale prices into businesses with real value. The margin of safety is not just a number you calculate. It is a state of mind, a commitment to never overpay and to always demand a significant discount for the uncertainty of the future. It is the recognition that in an uncertain world, the only true risk management is buying assets for substantially less than they are worth. It is the humility to admit that you will be wrong sometimes, and to build your entire strategy around surviving those errors rather than pretending they won't happen. Without this secret, all your analysis is meaningless. You can perfectly understand a business's economics, identify its wide moat, and project its future cash flows with precision, but if you pay too much for it, you will still lose money. The margin of safety is the bridge between analysis and outcome. It is what separates intelligent investors from intelligent speculators. Master this secret, and you will never again feel pressured to buy an asset simply because everyone else is buying it, or because you might miss out. You will develop the courage to be lonely, to be patient, to wait for the pitch you can hit out of the park rather than swinging at every ball that comes near the plate. This is the secret that Wall Street cannot sell you, because it requires inaction, patience, and discipline rather than constant trading and hot tips. And that is precisely why it is so valuable. The fourth billionaire secret that Warren Buffett has weaponized to build his fortune, while ordinary investors remain blind to its power, is his obsessive focus on owner earnings rather than reported accounting earnings. This distinction seems technical, even boring to most people, but it is the difference between identifying businesses that truly create wealth for their owners and falling for accounting illusions that destroy capital over time. Wall Street analysts, fund managers, and financial media are slaves to earnings per share, a number that can be easily manipulated through accounting choices, one-time events, depreciation schedules, and financial engineering. Buffett ignores this noise completely. He looks past the income statement to the cash flow statement, searching for what he calls owner earnings, a concept he defined with surgical precision in his 1986 letter to shareholders. Owner earnings are calculated as reported earnings plus non-cash charges like depreciation and amortization, minus the average annual amount of capitalized expenditures required to maintain the business's long-term competitive position. The critical subtraction, the one that Wall Street deliberately obscures, is maintenance capital expenditures. This is the money a business must spend just to keep its current operations running at their present level, not to grow, but simply to stand still. Many companies report strong net income but are forced to reinvest a huge portion of it back into the business just to maintain their market share and competitive position. These are poor businesses from an owner's perspective. They look profitable on paper but generate little actual cash for shareholders. A high-quality business, in Buffett's view, is a cash cow. It generates enormous amounts of cash from its operations and requires very little maintenance capital to sustain its earnings power. Think of See's Candies, which Berkshire acquired in 1972 for $25 million. Once the brand recognition was established and the store network optimized, the ongoing capital needs were minimal, mostly just store refreshes and modest inventory investments. Almost all the profit flowed directly to the owner as usable cash that Buffett could deploy into other wonderful businesses without ever touching the See's operation itself. Over 50 years, See's has generated over $2 billion in pre-tax earnings for Berkshire, while requiring less than $50 million in incremental capital investment. That is the hallmark of an extraordinary business. This is why Buffett loves businesses with light capital requirements and strong, predictable cash flows. Consumer brands with pricing power, insurance companies that collect premiums today and pay claims years later, creating float, railroads with monopolistic routes and pricing power, and utilities with regulated returns on invested capital. He systematically avoids capital-intensive industries like airlines, steel manufacturing, or automobile production, where constant, massive reinvestment is needed just to survive technological change and competition, leaving little for the owners. When you evaluate a company, you must look beyond the headline EPS number that CNBC screams about every earnings season. You must dive into the cash flow statement and answer one critical question. How much of this company's reported profit is actually free cash flow available to shareholders after funding all necessary maintenance of the business? A company that consistently converts 80% or more of its net income into free cash flow is a high-quality business worthy of deep study. One that converts less than 40% or worse, has negative free cash flow despite positive net income, is likely a value trap, no matter how cheap its price-to-earnings ratio may appear. This secret teaches you to think like a true owner who cares about the actual cash-generating power of the enterprise, not the accounting illusions presented on an income statement designed to satisfy regulators and analysts. It reveals why some businesses with modest growth rates create immense wealth for owners, because they generate gushers of cash that can be redeployed at high rates of return, while hypergrowth companies with negative cash flow often destroy shareholder value despite exciting headlines. Consider Amazon in its early decades. It reported minimal profits while reinvesting every dollar of cash back into warehouses, servers, and logistics infrastructure. Many investors called it a fraud. Buffett avoided it for years. But Jeff Bezos was using that reinvestment to build an unassailable moat. Once the infrastructure was in place, Amazon's free cash flow exploded, validating the strategy. Contrast this with WeWork, which also reported massive growth but was burning cash on unprofitable leases and had no path to positive free cash flow. The difference wasn't growth, it was the quality of earnings and the ultimate cash-generating power of the business model. Buffett eventually invested in Amazon in 2019 not because of its growth story, but because he finally understood its path to durable free cash flow generation. This secret also explains Buffett's love affair with insurance. Through Geico, General Re, and other insurers, Berkshire collects over $100 billion in premiums annually before paying out claims, sometimes years later. This float is essentially free leverage that Buffett invests in stocks and businesses. The insurance operations themselves often break even on underwriting, meaning the float costs Berkshire nothing. This is an extraordinary business model that generates massive cash without requiring equity capital from shareholders. No amount of accounting manipulation can create this kind of economic reality. It either exists in the cash flows or it doesn't. Mastering this secret requires you to become fluent in cash flow statements, to understand the difference between growth capex and maintenance capex, and to develop a nose for businesses that print cash versus those that consume it. It means ignoring Wall Street's obsession with non-GAAP earnings, adjusted EBITDA, and other creative metrics designed to make weak businesses look strong. You will learn to spot the red flags. Companies that consistently have large gaps between net income and operating cash flow, businesses that require constant equity issuances or debt increases to fund operations, and firms where depreciation charges are consistently exceeded by actual capital expenditures, meaning the assets are wearing out faster than accounting assumes. This secret is Wall Street's worst nightmare because it cannot be faked. You cannot manipulate real cash generation the way you can manipulate earnings through accounting choices. When you focus on owner earnings, you cut through the noise and see the economic reality of a business with crystal clarity. And in that clarity lies immense profit opportunity, because the market often misprices businesses based on accounting earnings while ignoring their true cash-generating power. This is how Buffett found Coca-Cola in the late 1980s, not because of its earnings growth, but because he recognized its ability to generate enormous free cash flow with minimal capital investment, a quality that would compound value for decades. Learn to see businesses through the lens of owner earnings, and you will spot opportunities that Wall Street's accounting-obsessed analysts completely miss. The fifth billionaire secret that separates Warren Buffett from every other investor on the planet, and the one that cannot be taught in business school, is his mastery of rationality and emotional detachment in the face of market chaos. This is not a technical skill or analytical framework. It is a psychological discipline so rare that it constitutes a genuine competitive advantage in the zero-sum game of capital allocation. Buffett himself has stated that temperament is more important than intellect in investing. You can have an IQ of 160, a PhD in finance, and access to the best research in the world. But if you cannot control your emotions when markets crash or when your neighbors are getting rich in a bubble, you will fail. Your greatest enemy in investing is not a bear market, not a bad stock pick, not even inflation. It is your own brain, wired by evolution for survival in the savannah, not for rational decision-making in complex financial markets. Neuroscience has confirmed what Buffett intuited decades ago. The human brain processes financial losses in the same regions that process physical pain. When your portfolio drops 20%, you feel actual physiological distress, increased heart rate, cortisol flooding your system, activation of the amygdala that triggers fight or flight responses. In this state, your prefrontal cortex, the rational, analytical part of your brain, goes partially offline. You become incapable of clear thinking precisely when you need it most. This is why investors sell at the bottom of crashes and buy at the top of bubbles. Not because they lack information, but because they lack emotional regulation under stress. Buffett has spent 70 years training his temperament to override these hardwired responses. His famous quote, "Be fearful when others are greedy and greedy when others are fearful," is the ultimate expression of this secret. It is simple to say but extraordinarily difficult to execute because it requires swimming against the most powerful current in human psychology. Social proof. When everyone around you is euphoric, buying everything in sight, and getting rich on paper, your brain screams at you to join the party or be left behind forever. When everyone is panicking, selling everything, and predicting depression, your brain screams at you to preserve what little capital remains before it vanishes completely. To act contrary to these impulses requires a level of self-awareness and discipline that few possess. Buffett achieves this rationality through multiple reinforcing practices. First, he has a deep understanding of his own circle of competence and a decades-long time horizon that renders short-term volatility meaningless noise. He doesn't watch stock tickers. He doesn't read financial news daily. He reads annual reports and thinks about businesses as ongoing enterprises that will exist for decades. Second, he structures his life and business to eliminate forced selling. Berkshire Hathaway generates tens of billions in annual operating cash flow from its wholly owned businesses, railroads, utilities, insurance, consumer brands. This means Buffett never needs to sell a stock investment because he needs cash. He can hold positions through any storm because his lifestyle and business operations are funded by cash-generating enterprises, not by liquidating marketable securities. This structural advantage is available to individual investors who build portfolios with sufficient cash reserves and who never invest money they might need in the next 5 to 10 years. Third, he personifies the market as Mr. Market, a manic-depressive business partner who offers to buy or sell his share of the business every single day. Sometimes Mr. Market is wildly optimistic, offering ridiculous prices far above intrinsic value. Sometimes he is deeply depressed, offering fire sale prices far below intrinsic value. A rational investor doesn't take his cues from Mr. Market's mood swings. Instead, he uses Mr. Market's irrationality to his advantage, selling to him when he is euphoric and buying from him when he is despondent. This mental model creates emotional distance between the investor and market price movements. You are not watching your money go up and down. You are observing the emotional state of a fictional partner whose offers you can accept or reject based solely on your own independent valuation. Cultivating this rationality is a lifelong practice that requires deliberate training. Buffett didn't wake up one day immune to fear and greed. He built his temperament through decades of conscious effort, reinforced by a life philosophy centered on simplicity, long-term thinking, and intrinsic motivation rather than external validation. For individual investors, this secret can be developed through specific practices. Building a portfolio you can sleep well with so you are never forced to sell in a panic. Writing a detailed investment policy statement that specifies exactly what you will do in various market scenarios and then following it mechanically to remove emotion from decisions. Surrounding yourself with rational, long-term thinkers and avoiding the noise of financial media that deliberately triggers emotional responses. To drive engagement, practicing meditation or other mindfulness techniques to strengthen the prefrontal cortex's ability to regulate emotional impulses. And most importantly, rehearsing market crashes mentally before they happen. Visualizing your portfolio dropping 40%, imagining the headlines screaming "worst crash since 1929" and practicing your calm, pre-planned response of buying more rather than selling. This mental rehearsal builds neural pathways that activate during actual stress, overriding panic with practiced response. Buffett has lived through every major market crash since the 1950s, 1973 to 74 when his partnership lost 50%, 1987's Black Monday, the dot-com bubble burst of 2000 to 2002, the financial crisis of 2008 when Berkshire stock fell 35%, and the pandemic crash of 2020. In each case, he did not panic. In each case, he used the opportunity to deploy capital at extraordinary prices. This was not luck. It was temperament forged through decades of preparation. Wall Street profits from your emotional instability. They design trading apps with dopamine-triggering notifications. They fill 24-hour news channels with fear-mongering headlines. They create social media ecosystems where investment decisions become identity markers subject to tribal warfare. They want you emotional because emotional investors trade frequently, pay fees, and make catastrophic errors at market extremes. Buffett's emotional mastery is the antidote to this entire ecosystem. Cannot be packaged and sold. Cannot be automated by an algorithm. It must be cultivated within yourself through conscious practice and life design. This secret is the glue that holds all the others together. Without emotional discipline, even perfect analysis of moats and margins of safety will be undone by a moment of panic or greed at the worst possible time. With it, even modest analytical skills can generate extraordinary long-term results because you will avoid the catastrophic errors that destroy most investors' compounding curves. Master this secret and you will have achieved what 99.9% of investors never do: the ability to act rationally when the world around you has lost its mind. And in the markets, that ability is worth billions. The sixth billionaire secret that Warren Buffett has harnessed to transform modest capital into a $900 billion empire is his profound understanding and exploitation of the magic of compounding, the most powerful force in finance that remains invisible to those focused on short-term gains. Buffett often says that his wealth has come from a combination of living in America, some lucky genes, and compound interest. This is not false modesty. It is a precise diagnosis of reality. Compounding is not merely earning returns on your capital. It is earning returns on your returns year after year, decade after decade, until the curve of growth becomes almost vertical. The mathematics are deceptively simple but psychologically incomprehensible to the human mind, which evolved to think linearly. A 7% annual return doubles your money every 10 years. A 10% return doubles it every 7 years. A 15% return doubles it every 5 years. Over 50 years, that 15% annual return turns $100,000 into more than $100 million. Not through spectacular home runs, but through the quiet, relentless accumulation of modest gains that build upon themselves exponentially. Buffett's net worth trajectory illustrates this perfectly. He became a millionaire at age 32. At age 50, his net worth was approximately $67 million. Nothing extraordinary by billionaire standards. But then compounding took over. By age 60, his net worth crossed $1 billion. By age 80, it exceeded $60 billion. And today, in his mid-90s, it approaches $100 billion. Notice the pattern. 98% of his wealth was accumulated after his 50th birthday. This is not because he suddenly became smarter or discovered new secrets after 50. It is because compounding requires time to work its magic. The curve is flat for decades, then suddenly rockets upward in the final years. Most investors never experience this rocket phase because they interrupt compounding through catastrophic errors, excessive fees, taxes, or emotional selling during inevitable downturns. Buffett understands that the enemy of compounding is not low returns. It is the loss of capital. A single 50% loss requires a 100% gain just to break even, which destroys years of compounding progress instantly. This is why his first rule is never lose money, and his second rule is never forget rule number 1. He is not claiming he never experiences paper losses. He has seen his portfolio decline 50% multiple times. He means never suffer permanent loss of capital through investing in businesses that fail completely or through excessive leverage that forces liquidation at the worst possible time. Preserving capital is paramount because it keeps the compounding engine running uninterrupted. This secret demands extreme patience and a complete disregard for short-term performance relative to benchmarks or neighbors. Buffett does not care if the S&P 500 outperforms Berkshire in any given year or even any given decade. He cares only about the long-term compounding of intrinsic value per share. He is playing a different game than everyone else on Wall Street, who are judged on quarterly results and fired if they underperform for 2 consecutive years. Buffett is playing an infinite game, focused on the long arc of wealth creation measured in decades, not quarters. He looks for businesses he can own forever, companies with durable competitive advantages that will still be earning high returns on capital 50 years from now. When he bought Coca-Cola in 1988, he wasn't thinking about next quarter's earnings. He was thinking about whether people would still be drinking Coke in 2050. His answer was yes, and that long-term conviction allowed him to hold through multiple recessions, currency crises, and health scares about sugar without selling a single share. The power of compounding also explains Buffett's aversion to excessive fees and taxes, what he calls frictional costs, that silently erode returns over time. A 2% annual fee on an investment fund seems small in any single year. But over 40 years, that 2% fee consumes more than 50% of your total potential gains. This is why Buffett bet $1 million in 2007 that a simple S&P 500 index fund would outperform a portfolio of hedge funds over 10 years, and won decisively. The hedge funds charge 2% management fees plus 20% performance fees, while the index fund charged less than 0.1%. The difference in net returns after fees was staggering, all due to the silent killer of compounding: friction. For individual investors, this secret translates into several non-negotiable practices. Start investing as early as possible. Time is your most valuable asset, and the difference between starting at age 25 versus 35 can mean millions in final wealth even with identical annual contributions. Minimize all frictional costs including management fees, trading commissions, and unnecessary taxes by holding investments long-term to qualify for lower capital gains rates. Avoid leverage. That could force you to sell during downturns and interrupt your compounding curve. And most importantly, develop the psychological stamina to stay invested through multiple market cycles without panic selling at bottoms. This requires building a portfolio with sufficient cash reserves and bonds so that stock market declines never threaten your lifestyle or force liquidation. Buffett structures Berkshire to generate massive operating cash flow precisely so he never needs to sell stocks during crises. He can actually buy more. You can replicate this principle by maintaining an emergency fund of 6 to 12 months of expenses in cash, and by never investing money you might need within the next 5 to 10 years in volatile assets. The tyranny of time works both ways. It is your greatest ally if you start early and stay disciplined, but your cruelest enemy if you start late or interrupt compounding through emotional decisions. This secret is democratizing. It does not require genius stock picks or insider information. It requires only 3 things: a reasonable rate of return above inflation, an extremely long time horizon, and the discipline to avoid catastrophic errors that reset your compounding clock. Most investors fail not because they lack intelligence, but because they lack patience. They chase the hot stock of the moment, trade frequently based on news headlines, and sell in panic during inevitable 20% market corrections. Each of these actions resets their compounding clock, forcing them to start over just as the magic was about to begin. Buffett's genius is not that he earns spectacular returns. He has averaged approximately 20% annually over his career, impressive but not supernatural. His genius is that he has maintained that return for 70 consecutive years without a single catastrophic loss that would have destroyed decades of compounding. That consistency, that survival instinct, is worth more than any brilliant stock pick. It is the difference between ending life with $100 million versus $1 million, despite identical average annual returns, simply because one investor stayed in the game uninterrupted while the other suffered a single 50% loss that took years to recover from. Master the secret, and you will stop obsessing over finding the next 10-bagger stock. You will focus instead on building a portfolio of high-quality businesses you can hold for decades, minimizing frictional costs, and developing the emotional discipline to stay the course through multiple market cycles. You will understand that wealth is not built in bull markets. It is preserved in bear markets, and that preservation is what allows compounding to work its magic over time. This is the secret Wall Street cannot sell you because it requires inaction, patience, and a multi-decade horizon. Qualities that generate no fees, no commissions, and no quarterly performance anxiety. And that is precisely why it remains available to any individual with the discipline to embrace it. The seventh and final billionaire secret that completes Warren Buffett's investment philosophy, and the one that Wall Street actively works to suppress because it destroys their entire business model, is his strategic embrace of inactivity as the highest form of financial intelligence. In a world that glorifies constant action, rapid trading, and the illusion that every market fluctuation demands a response, Buffett's greatest strength is his ability to do absolutely nothing for extended periods while the world around him descends into frenzy. He believes that the stock market is a device to transfer money from the active to the patient. His portfolio turnover is famously low, often less than 5% annually, compared to 100% or more for the average mutual fund. He once said that his ideal holding period is forever, and that if he couldn't hold a stock for 10 years, he wouldn't hold it for 10 minutes. This philosophy of strategic inactivity is the antithesis of Wall Street's entire ecosystem. Brokers earn commissions on every trade. Fund managers charge fees based on assets under management, and to justify their existence and high salaries, they constantly churn portfolios, buying and selling stocks not because fundamentals have changed, but because inactivity would reveal that their services are unnecessary. This activity creates enormous hidden costs: commissions, bid-ask spreads, market impact costs when trading large positions, and most significantly, capital gains taxes that can consume 30 to 40% of your profits when triggered by short-term trading. Over a 30-year investment horizon, these frictional costs can silently destroy 50% or more of your potential wealth, not through bad investments, but through unnecessary activity. Buffett's approach eliminates these costs entirely. He does his homework once, reading annual reports, analyzing competitive dynamics, calculating intrinsic value with a margin of safety, and then buys a wonderful business at a fair price. After that, he largely forgets about it. He lets the management team run the business and the power of compounding do its work. He doesn't react to every piece of economic news, every Federal Reserve announcement, or every market fluctuation because he understands that most of this noise is irrelevant to the long-term value of a great business. Coca-Cola will still be selling syrup to bottlers in 190 countries whether the Fed raises rates by 25 basis points next month or not. American Express will still have millions of affluent cardholders spending billions annually regardless of next quarter's GDP number. These businesses operate on decade-long cycles, not quarterly ones. Buffett's famous 20-slot punch card analogy perfectly illustrates this secret. Imagine you were given a punch card with only 20 slots in your entire lifetime. Every time you made an investment, bought a stock, started a business, acquired a property, you had to punch a slot. You would have only 20 investment decisions available to you from age 20 to age 90. This constraint would force you to be incredibly thoughtful. You would spend months, even years, researching each opportunity. You would wait patiently for truly exceptional situations rather than deploying capital in mediocre ideas just to put money to work. You would think deeply about holding periods because each sale and repurchase would consume 2 precious slots. You would stop wasting your opportunities on speculative gambles and focus exclusively on high-conviction, long-term compounders. This mindset of scarcity around decisions leads to dramatically higher quality and far better long-term results. Most investors operate with an illusion of infinite opportunities. They can trade anytime, buy anything, sell whenever they want. This abundance mindset leads to promiscuous portfolio behavior, buying stocks after reading a single article, selling after a 10% drop because it's not working, constantly rotating into the latest hot sector. Each of these actions consumes mental energy, generates costs, and interrupts compounding, all for no demonstrable benefit. Academic research has consistently shown that the most active traders underperform the market by the widest margins, while the least active investors, those who buy and hold diversified portfolios, achieve returns closest to the market's long-term average. The difference is entirely due to costs and behavioral errors triggered by excessive activity. Buffett takes this principle even further with his acquisition strategy for entire businesses. When Berkshire buys a company like See's Candies or BNSF Railway, There is no public market to sell into. The decision is permanent. This forces extreme discipline in the initial analysis. You must be right because you cannot change your mind later. Buffett applies this same mental model to his stock investments, even though he technically could sell anytime. He asks himself, would I be comfortable owning this business forever if the stock market closed for 10 years? If the answer is no, he doesn't buy it. This filter eliminates 99% of potential investments and leaves only businesses with durable competitive advantages that can compound value through multiple economic cycles. The strategic inactivity secret also extends to Buffett's approach to macroeconomics and market timing. He does not attempt to predict recessions, interest rate movements, or geopolitical events. He has stated repeatedly that he has no idea what the stock market will do tomorrow, next month, or next year, and he doesn't need to know. His entire strategy is built on the assumption that capitalism will continue to create value over decades, that wonderful businesses will continue to grow their earnings power over time, and that market panics will periodically offer opportunities to buy these businesses at discounts to intrinsic value. He doesn't need to time these panics. He just needs to be prepared with cash when they arrive, which is why Berkshire maintains large cash positions even when it means underperforming in raging bull markets. This patience is excruciating for most investors. Watching your portfolio lag the market by 20% while everyone else gets rich creates intense psychological pressure to do something, to chase performance, to increase risk, to abandon discipline. Buffett has endured this pressure multiple times in his career. During the dot-com bubble of 1999, during the FANG stock mania of 2017 to 21, and during the meme stock frenzy of 2021. Each time, he lagged significantly. Each time, commentators declared his approach obsolete. Each time, he did nothing, maintained his discipline, held his cash, and waited. And each time, when the bubble burst, he was positioned to deploy capital at extraordinary prices while others were selling in panic. This is the ultimate expression of strategic inactivity. The courage to be bored, to be left behind temporarily, to be mocked by peers, all while maintaining unwavering conviction in your principles. Wall Street cannot sell you inactivity. They cannot charge fees for doing nothing. They cannot generate commissions from patience. This is why their entire media ecosystem, from CNBC to financial Twitter to investment newsletters, is designed to create a sense of urgency around every market tick, to make you feel that inaction is the greatest risk of all. They profit from your anxiety, your FOMO, your belief that you must constantly adjust your portfolio to survive. Buffett's secret reveals the truth. In investing, often the best move is no move at all. The most valuable skill is the ability to sit quietly while others frantically trade themselves into poverty. This secret requires you to redefine what it means to be a good investor. It is not someone who makes frequent brilliant decisions. It is someone who makes a few excellent decisions and then has the discipline to do nothing while those decisions compound over decades. It is not someone who reacts quickly to news. It is someone who filters out noise and focuses only on what truly matters for long-term business value. It is not someone who seeks excitement. It is someone who embraces boredom as the price of extraordinary long-term results. Master this secret, and you will transform your relationship with markets. You will stop checking stock prices daily. You will unsubscribe from financial news alerts. You will build a portfolio so robust and so well understood that it can weather any storm without your constant tinkering. You will discover that the path to wealth is not a series of heroic actions but a single decision, made with extreme care, followed by decades of disciplined inaction. This is the final secret because it is the culmination of all the others. Only when you understand your circle of competence, recognize economic moats, demand margins of safety, focus on owner earnings, maintain emotional rationality, and respect the power of compounding can you truly embrace strategic inactivity. Without these foundations, inactivity is merely laziness or ignorance. With them, inactivity becomes the highest form of financial intelligence, a weapon that transfers wealth from the impatient to the patient, from the active to the still, from the emotional to the rational. And in today's hyperactive financial world, that weapon remains available to anyone with the courage to wield it. Now that we have explored the 7 core secrets individually, we must understand how they interlock into a single, coherent philosophy that has withstood every market environment for 7 decades. The circle of competence defines your battlefield. You only fight where you have an edge. The search for economic moats identifies your targets. You only attack businesses with durable competitive advantages that can compound value for decades. The margin of safety determines your price. You only buy when the odds are overwhelmingly in your favor, with a cushion for error. The focus on owner earnings measures quality. You only invest in businesses that generate real cash for owners rather than accounting illusions. The discipline of rationality governs your behavior. You remain calm when others panic and cautious when others become euphoric. The respect for compounding sets your time horizon. You think in decades, not days, understanding that wealth is built slowly then suddenly. And the strategy of inactivity protects your results. You avoid the frictional costs and behavioral errors that destroy compounding through unnecessary action. These are not 7 separate tactics to be applied independently. They are 7 expressions of a single worldview that sees investing not as speculation but as business ownership, not as trading but as capital allocation, not as a short-term game but as a lifelong practice of rational decision-making under uncertainty. Wall Street panics when investors discover this philosophy because it renders their entire industry obsolete. If every investor adopted Buffett's approach, buying wonderful businesses at fair prices with margins of safety, holding them for decades while ignoring market noise and minimizing costs, the demand for stock tips, hot mutual funds, daily market commentary, and frequent trading would evaporate overnight. The financial industry's business model depends on convincing you that investing is complex, that you need constant guidance, that markets are unpredictable, and therefore you must react to every headline. Buffett's philosophy reveals the truth. Investing is simple but not easy. The principles are straightforward: buy assets worth more than you pay for them and hold them patiently, but executing them requires emotional discipline that most people lack. This gap between simplicity and difficulty is where Wall Street profits. They cannot make money selling simplicity, so they sell complexity. They cannot charge fees for patience, so they sell urgency. They cannot profit from your inactivity, so they create anxiety that demands constant action. Your liberation begins when you see through this illusion and embrace the 7 secrets not as techniques but as a way of being in financial markets. This requires more than reading books or memorizing principles. It requires rewiring your relationship with money, time, and uncertainty. It requires building a life where your self-worth is not tied to quarterly portfolio statements, where your identity is not wrapped up in being a smart investor who makes brilliant trades, where your happiness does not depend on outperforming your neighbors. Buffett himself has emphasized this repeatedly. The foundation of his financial success is not intelligence or information advantage. It is a life built on purposeful work, loving relationships, and gratitude for what he has. This emotional foundation gives him the stability to remain rational when markets crash because his identity and happiness do not depend on his net worth. He can afford to be patient because he is already content. He can afford to be contrarian because he does not need external validation. He can afford to hold cash for years waiting for opportunities because his lifestyle is funded by operating businesses, not by liquidating investments. Most investors try to copy Buffett's tactics without building this foundation, and they fail spectacularly. They buy Coca-Cola stock but panic sell when it drops 20%. They talk about moats and margins of safety but chase meme stocks when FOMO hits. They read about compounding but trade daily based on CNBC headlines. Without the emotional and life foundation, the tactics are meaningless. The 7 secrets must be integrated into your entire approach to wealth, not just your brokerage account. This means living below your means so you can invest consistently without pressure. It means building multiple income streams so you never need to sell investments at inopportune times. It means cultivating relationships and hobbies outside of finance so your identity isn't tied to market performance. It means practicing gratitude for what you have so you don't chase speculative returns out of greed or fear of missing out. It means developing a long-term perspective on life itself, not just investing, understanding that most meaningful things compound slowly: relationships, health, knowledge, character. When you see compounding as a universal principle rather than just a financial concept, you naturally extend the patience required for investment compounding to all areas of life. This holistic integration is what Wall Street cannot teach you and cannot sell you. It must be built within yourself through conscious practice over years. But the reward is nothing less than financial freedom combined with emotional peace. The ability to navigate any market environment without anxiety, to sleep soundly during crashes, to deploy capital courageously when others are panicking, and to compound wealth steadily over decades without the emotional roller coaster that destroys most investors. The 7 secrets are available to anyone willing to do the work, not the work of complex analysis, but the harder work of self-mastery. They require no special credentials, no insider access, no expensive tools. They require only discipline, patience, and the courage to be different when the crowd is screaming for you to conform. This is why Buffett's approach remains as relevant today as it was 70 years ago. Human nature hasn't changed, market cycles haven't changed, and the mathematics of compounding hasn't changed. What has changed is the noise level, the 24-hour news cycle, social media echo chambers, and algorithmic trading that amplify short-term volatility and trigger emotional responses. In this environment, Buffett's secrets are more valuable than ever because they provide an anchor of rationality in a sea of chaos. They are not outdated relics of a simpler time. They are timeless principles that become more powerful as the world becomes more frenetic. The investor who can remain still while others panic, who can see value when others see only risk, who can wait patiently for opportunities while others chase every headline. That investor will always be rewarded in every market environment, in every generation. This is the promise of the 7 secrets. Not guaranteed riches, but a framework for making rational decisions under uncertainty that has been tested and proven across every major market cycle since World War II. It is a path that requires no genius, only discipline. No special information, only patience. No market timing, only preparation. And in a world selling complexity, that simplicity is the ultimate competitive advantage. Let us now examine how Warren Buffett applied these 7 secrets during his most challenging period, the financial crisis of 28 and 29, when even his legendary status was questioned and Berkshire Hathaway stock fell 35% while the broader market collapsed. This case study reveals not just the mechanics of his philosophy but its emotional demands, the courage required to deploy capital when the world appears to be ending. In late 27, as subprime mortgage defaults began accelerating, Buffett recognized the fragility of the financial system but did not attempt to time the crash. He maintained Berkshire's substantial cash position, over $40 billion, not because he predicted the exact timing of the collapse, but because he could not find businesses trading at prices that offered adequate margins of safety relative to their intrinsic value. This patience was excruciating. While leveraged hedge funds were generating 20% annual returns by riding the credit bubble higher, Berkshire lagged significantly. Critics questioned whether Buffett had lost his edge in a new, complex financial world he didn't understand. He did not respond defensively. He did not abandon his principles to chase performance. He simply waited, preserving capital while others took on dangerous leverage. When Lehman Brothers collapsed in September 28, triggering global financial panic, Buffett was prepared. Within weeks, he engineered 3 landmark deals that exemplified all 7 secrets in action. First, he invested $5 billion in Goldman Sachs preferred stock yielding 10% dividends plus warrants to buy common stock at $115 per share. Let's unpack how each secret operated here. His circle of competence. He understood Goldman's franchise value as a premier investment bank with global client relationships, even if he didn't understand every complex derivative on its balance sheet. Economic moat. Goldman's brand, talent network, and client relationships created a durable advantage that would survive the crisis even if earnings temporarily collapsed. Margin of safety. The 10% dividend yield provided immediate cash return, while the warrants offered enormous upside if Goldman recovered, creating asymmetric risk-reward. Owner earnings. He focused on Goldman's ability to generate future cash flows once the crisis passed, not its temporarily impaired quarterly earnings. Rationality. He deployed capital while others were panicking, buying when fear was maximal. Compounding. He structured the deal to generate immediate income while positioning for long-term recovery. Inactivity. He held the position for years without tinkering, allowing Goldman to recover and eventually exercising the warrants at enormous profit. Second, he invested $3 billion in General Electric under similar terms, preferred stock with 10% dividend plus warrants. GE was facing a perfect storm. Collapsing industrial demand, frozen commercial paper markets threatening its financing arm, and fears of insolvency. Buffett saw through the panic to GE's enduring industrial franchises, aviation, power generation, healthcare, that would survive the crisis and continue generating cash for decades. The margin of safety was enormous. GE's industrial assets alone were worth far more than the market capitalization implied when panic selling hit. Third, and most audaciously, in early 2011, after Bank of America faced its own crisis following mortgage-related losses, Buffett invested $5 billion in BAC preferred stock with a 6% dividend plus warrants to buy 700 million shares at $7.14 per share. At the time, BAC stock traded around $7 and many analysts predicted bankruptcy. Buffett saw what others missed. Bank of America's deposit base of $1 trillion, essentially free funding, and its nationwide branch network created an unassailable moat in retail banking that would survive even severe credit losses. The intrinsic value of those deposits alone exceeded the entire market capitalization of the company during the panic. By 2015, when Buffett exercised the warrants, BAC stock had tripled, generating billions in additional profit beyond the dividend income. These crisis investments were not acts of heroism or market timing. They were the mechanical application of Buffett's 7 secrets when market panic created extraordinary margins of safety. The real genius was not in making the investments. It was in having the cash available to make them while others were forced sellers. Berkshire's operating businesses, railroads, utilities, insurance, consumer brands, continued generating tens of billions in annual cash flow even as financial markets froze. This structural advantage meant Buffett never needed to sell depressed assets to raise cash. He could actually buy more. Individual investors can replicate this principle by maintaining adequate cash reserves, 10 to 20% of portfolio value in short-term treasuries or money market funds, specifically earmarked for deployment during market crises. This requires discipline during bull markets when holding cash means underperforming the market. But that temporary underperformance is the price of having dry powder when opportunities arrive. Most investors fail this test. They deploy 100% of capital during good times. Then when crashes hit, they have no ammunition to buy discounted assets. They become forced sellers rather than opportunistic buyers. Buffett's crisis playbook reveals another critical insight. He did not try to catch the bottom. He did not wait for markets to stop falling before investing. He began deploying capital when fear was intense but before the absolute bottom was reached. Goldman deal in October 28, GE in October 28, BAC in August 2011 when markets were still volatile. This is crucial because no one can predict the exact bottom. Waiting for certainty means missing the best opportunities. Buffett's approach: when assets trade at 50% discounts to conservative intrinsic value estimates, begin deploying capital in tranches, 20% at 20% market decline, another 20% at 30% decline, final 20% at 40% decline. This averaging approach eliminates the need for perfect timing while ensuring you participate in the recovery. The emotional challenge during 28 was immense even for Buffett. Berkshire stock fell 35%, wiping out tens of billions in market value. His personal net worth declined by over $15 billion on paper. Yet he did not panic. He did not sell holdings to preserve capital. He did not retreat into ultra-safe assets. He leaned forward, deploying capital precisely when his own portfolio was underwater. This requires a level of emotional detachment that comes only from decades of temperament training and a life not defined by net worth fluctuations. For individual investors, the lesson is clear. Your behavior during the next crisis will determine your lifetime investment results more than your intelligence, your stock picks, or your market timing. Will you be the seller providing liquidity to Buffett-like buyers? Or will you be the buyer acquiring quality assets at distressed prices? The answer depends not on what you know during the crisis. It depends on how you prepare today. Build your fortress now. Accumulate cash gradually. Reduce exposure to fragile businesses without moats. Increase allocation to durable franchises with pricing power. Most importantly, rehearse your response mentally until calm buying during panic becomes your automatic reaction rather than forced discipline. Study the 28 crisis in detail, read Buffett's shareholder letters from that period, analyze his crisis investments, understand how he thought about risk and opportunity when others saw only catastrophe. This mental preparation builds neural pathways that activate during actual stress, overriding panic with practiced response. Buffett survived 28 not because he predicted the crisis, he didn't, but because he was prepared for it. He had cash, he had courage, and he had a philosophy that turned panic into opportunity. You can do the same when the next crisis arrives, because it will arrive. It always does. The only variables are timing and severity. Your preparation determines your outcome. We must now address the most dangerous misconception about Warren Buffett's approach: the belief that his success came from finding undervalued cigar but stocks trading below liquidation value, the strategy he learned from Benjamin Graham in his early career. This misunderstanding causes countless investors to search for statistically cheap stocks with no regard for business quality, leading them into value traps that destroy capital despite seemingly attractive valuations. Buffett himself evolved beyond cigar but investing after meeting Charlie Munger in the 1960s, and this evolution represents one of the most important transitions in investment history, one that most value investors still haven't fully embraced. In his early partnership years, Buffett followed Graham's formula religiously: buy stocks trading below net working capital, meaning the company's current assets exceeded its total market capitalization. These were often terrible businesses: textile mills, obsolete manufacturers, companies in terminal decline. But they offered statistical safety because even if the business failed completely, the liquidation value of its assets would return capital to shareholders. Buffett's most famous cigar was Berkshire Hathaway itself. A struggling New England textile manufacturer, he began buying in 1962 because it traded below working capital. He later called this his worst investment ever, not because he lost money initially. He made a profit on the textile operations, but because the capital tied up in this dying business prevented him from deploying it into wonderful businesses that would have compounded value exponentially over decades. The opportunity cost was catastrophic. Berkshire's textile operations consumed 20 years of management attention and capital that could have been invested in See's Candies, Coca-Cola, or other compounders from the start. Buffett learned this lesson painfully and completely transformed his approach after Munger convinced him that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This single insight, prioritizing business quality over statistical cheapness, became the foundation of Buffett's extraordinary success from the 1970s onward. Let's examine the difference through concrete examples. A cigar butt approach in 2020 would have identified banks trading at less than 1 times book value during the pandemic crash, statistically cheap based on asset value. Many value investors bought these stocks expecting mean reversion to historical price-to-book ratios. Some banks recovered, but others faced permanent impairment as commercial real estate loans defaulted and net interest margins compressed structurally. The statistical cheapness masked fundamental business deterioration. Buffett's quality approach led him to buy Apple in 2016 not because it was statistically cheap. It traded at 14 times earnings, not a deep value multiple, but because he recognized its extraordinary economic moat. The ecosystem lock-in, the pricing power, the recurring services revenue, and the minimal capital requirements relative to cash generation. Apple required almost no incremental capital to grow its installed base and services revenue, creating enormous free cash flow that could be returned to shareholders or reinvested at high rates of return. This business quality mattered far more than the initial valuation multiple. Over the next 5 years, Apple's stock quintupled not because it became statistically cheaper. It actually traded at higher multiples, but because its intrinsic value compounded rapidly due to exceptional business performance. The cigar but investor searches for assets trading below liquidation value. The quality investor searches for businesses whose intrinsic value will compound at high rates for decades regardless of short-term valuation fluctuations. The cigar but investor fears overpaying by 10%. The quality investor fears missing a decade of compounding from a wonderful business because they demanded a 5% larger margin of safety. Both approaches require margins of safety, but they apply them to different things. The cigar butt approach applies margin of safety to asset value, buying assets for 70 cents on the dollar. The quality approach applies margin of safety to earnings power, buying a business whose conservative estimate of future cash flows is worth $100 per share for $70 today. The difference seems subtle but produces radically different portfolios and results over time. Cigar butt portfolios contain a collection of mediocre or declining businesses that occasionally pop when markets recognize their asset value, but then decline again as business fundamentals deteriorate. Quality portfolios contain a concentrated group of exceptional businesses that compound value year after year, decade after decade, creating wealth through business growth rather than valuation expansion. Buffett's portfolio evolution tells this story perfectly. His early partnerships held dozens of cigar-butt positions, statistically cheap stocks across many industries. His modern Berkshire portfolio holds concentrated positions in a handful of wonderful businesses: Apple, Bank of America, Coca-Cola, American Express, Kraft Heinz, Occidental Petroleum, companies with durable competitive advantages, strong cash generation, and management teams aligned with shareholders. He would rather own 100% of a business earning 12% on equity forever than 100% of a business earning 20% on equity for 3 years before competition destroys its advantages. This preference for durable high returns over temporary spectacular returns is the hallmark of the quality approach. For individual investors, the practical implication is profound. Stop screening for low price-to-book or low price-to-earnings ratios alone. Start screening for high returns on invested capital sustained over 10 years, strong free cash flow conversion, pricing power evidenced by consistent margin expansion, and management teams with skin in the game who allocate capital intelligently. These qualitative factors matter more than any single valuation metric. A business earning 20% returns on equity growing at 8% annually with minimal capital requirements is worth far more than a business earning 8% returns on equity growing at 2% annually, even if the latter appears statistically cheaper based on price-to-earnings ratios. The mathematics of compounding intrinsic value eventually overwhelms initial valuation differences. This is why Buffett could pay 25 times earnings for See's Candies in 1972 and still generate extraordinary returns. The business compounded its intrinsic value at 15% annually for 50 years, making the initial valuation irrelevant over time. The cigar-butt investor would have rejected See's at that price. The quality investor recognized that business quality would compound away any initial overpayment within a few years. This evolution from cigar butts to wonderful businesses represents Buffett's most important intellectual contribution to investing. Not because it's complex, but because it requires overcoming deep psychological biases. Humans are wired to fear overpaying. We feel immediate pain when we pay more than an item's apparent worth. We feel immediate pleasure when we get a bargain, even if the item itself is worthless. This bias makes cigar-butt investing emotionally satisfying but financially limiting. Quality investing requires tolerating the discomfort of paying what seems like a full price today for the promise of compounding value tomorrow, a promise that cannot be verified until years later. This delayed gratification is psychologically difficult but financially essential. Wall Street exploits our bias for statistical cheapness by selling value funds filled with low price-to-earnings stocks that often turn out to be value traps. Businesses that appear cheap because their earnings are temporarily inflated or their assets are impaired. True value is not statistical cheapness. It is the discount between price and conservatively estimated intrinsic value, where intrinsic value includes the present value of decades of future cash flows from a durable competitive advantage. Master this distinction, and you will avoid the value traps that destroy most value investors while capturing the compounding engines that build generational wealth. This is not a rejection of margin of safety, it is a refinement of it. The margin of safety must be applied to the right thing. Not asset value, but sustainable earnings power. Not liquidation value, but going concern value. Not what a business is worth if it fails, but what it is worth if it succeeds, and the probability-weighted average of all possible outcomes. This requires deeper analysis, longer time horizons, and greater comfort with uncertainty than cigar-butt investing. But the rewards, measured in decades of uninterrupted compounding, are exponentially greater. Buffett's journey from cigar butts to wonderful businesses is not just his personal evolution. It is a roadmap for every investor seeking to build lasting wealth rather than score occasional bargains. Follow it, and you will join the small minority who understand that in investing, quality compounders purchased at reasonable prices beat statistically cheap declining businesses every single time over multi-decade periods. The integration of technology into Warren Buffett's investment universe represents another critical evolution often misunderstood by investors who cling to caricatures of him as a Luddite who avoids all technology stocks. This misconception causes people to dismiss his entire philosophy as outdated in our digital age, a catastrophic error that misses his actual approach to technological change. Buffett has never avoided technology per se. He has avoided businesses he doesn't understand and businesses without durable competitive advantages, regardless of industry. His early avoidance of technology stocks in the 1990s wasn't a rejection of technology. It was a recognition that he couldn't reliably distinguish the winners from the losers in an industry undergoing radical disruption. He watched the dot-com bubble with bemusement not because he hated the internet, but because he saw companies with no earnings, no assets, and no path to profitability trading at billions in market value based purely on narrative. He couldn't calculate a margin of safety for businesses with no cash flows to discount. This wasn't ignorance, it was intellectual honesty. His circle of competence didn't include evaluating which internet startup would dominate search, e-commerce, or social networking when the industry's ultimate structure was unknowable. Fast forward to 2016, when Buffett began accumulating Apple stock, eventually building a $120 billion position that became Berkshire's largest holding. This wasn't a sudden change of heart about technology. It was recognition that Apple had evolved beyond a hardware company into a consumer products and services ecosystem with one of the most powerful economic moats in business history. Buffett didn't buy Apple because it was a tech stock. He bought it because it was a consumer behavior story with extraordinary pricing power, minimal capital requirements relative to cash generation, and switching costs so high that customers effectively rented their entire digital lives within Apple's walled garden. The iPhone wasn't a gadget to Buffett, it was a daily habit, a payment system, a photo album, a communication device, and an entertainment portal that users would replace every 2 years at premium prices regardless of economic conditions. The service's revenue, App Store, Apple Music, iCloud, grew at 20% annually with 80% margins, requiring almost no incremental capital investment. This was See's Candies with a balance sheet, recurring revenue from habitual consumer behavior with minimal capital requirements. Buffett understood this perfectly because it fit his circle of competence. Consumer behavior, brand loyalty, pricing power, and cash generation. He didn't need to understand semiconductor physics or iOS development. He needed to understand why consumers would keep buying iPhones even when Android phones offered similar features at lower prices. The answer was ecosystem lock-in, a moat he could see clearly even if he didn't use an iPhone himself. This case study reveals Buffett's actual approach to technology. He doesn't avoid sectors. He avoids businesses without understandable competitive advantages. If a technology company develops a durable moat through network effects, switching costs, or brand loyalty that he can understand, he will buy it regardless of industry classification. Conversely, he avoids non-technology businesses without moats, like airlines or retail department stores, because they lack pricing power and face brutal competition regardless of sector. The sector label is irrelevant. The economic characteristics are everything. This principle applies to artificial intelligence today. Buffett has stated he doesn't understand AI well enough to predict which companies will dominate the space long-term. A position of intellectual honesty, not ignorance. He sees AI as a general-purpose technology like electricity or the internet that will benefit society enormously but may not create concentrated profits for any single company because competition will drive returns to normal levels. This is a sophisticated insight many AI enthusiasts miss. Transformative technologies often create enormous consumer surplus but modest producer profits because competition prevents any single player from capturing most of the value. Electricity transformed civilization, but utility stocks have never been spectacular investments. The internet created trillion-dollar companies but destroyed even more value in disrupted industries and failed startups. AI may follow similar patterns, enormous societal impact with highly uncertain profit distribution across companies. Buffett's approach: wait until the dust settles and clear winners with durable moats emerge. Companies that have built pricing power, switching costs, or network effects around AI applications that competitors cannot easily replicate. He will not chase every AI startup trading on hype. He will not buy semiconductor stocks because AI needs chips. He will wait patiently until he can identify businesses where AI creates rather than destroys competitive advantages, and where he can calculate a margin of safety based on conservative estimates of future cash flows. This patience frustrates investors who want immediate exposure to the next big thing. But history favors Buffett's approach. During the dot-com bubble, investors who bought Cisco, Dell, and Microsoft at peak valuations in 2000 waited 15 years to recover their capital despite these companies becoming dominant players. The technology succeeded spectacularly, but the stocks failed investors because they paid too much relative to near-term cash flows. Investors who waited until 2003 to 2005 to buy these same companies at reasonable valuations participated fully in their long-term success without enduring the catastrophic drawdowns. Timing matters less than price relative to value. Buffett's technology approach teaches us to separate technological enthusiasm from investment discipline. Love the technology if you wish, but only invest when you can identify a specific business with a durable competitive advantage in that space trading at a price that offers a margin of safety relative to conservatively estimated cash flows. Do not invest in AI as a sector, invest in specific companies where AI creates rather than erodes moats, where management has proven capital allocation skills, and where the balance sheet can survive the inevitable hype cycle collapse that will separate real businesses from vaporware. This requires patience most investors lack. They want exposure now before they miss out. Buffett is willing to miss the first 100% gain if it means avoiding the subsequent 90% crash. He would rather buy a wonderful AI-enabled business at a fair price after the bubble bursts than buy a speculative AI story at an absurd price during mania. This discipline has allowed him to participate in technology's long-term success while avoiding its periodic crashes, a combination that has generated extraordinary risk-adjusted returns over decades. For individual investors, the practical lesson is clear. Do not avoid technology stocks categorically. Do not chase them categorically either. Evaluate each technology company on the same criteria as any other business. Does it have a durable competitive advantage you understand? Does it generate strong free cash flow relative to earnings? Does management allocate capital intelligently? Does it trade at a price offering a margin of safety relative to conservative estimates of long-term cash flows? If yes to all four, sector is irrelevant. If no to any, walk away regardless of technological excitement. This approach allowed Buffett to buy Apple at the right time, not too early during the Steve Jobs era when the business model was still evolving, not too late after the stock had already quintupled, but at the inflection point when the ecosystem moat became undeniable and the valuation offered a reasonable entry point. It will allow him to participate in AI's long-term success without blowing up during the inevitable mania and crash cycle that accompanies every transformative technology. And it can allow you to do the same, if you have the patience to wait for clarity rather than chasing uncertainty wrapped in hype. This is not outdated thinking, it is timeless thinking applied to new circumstances. The tools change, human nature doesn't. Bubbles form around every new technology. Crashes follow. Wonderful businesses emerge from the wreckage. Patient capital gets rewarded. Buffett's approach works in every era because it is based on unchanging principles of business economics and human psychology, not on sector preferences or technological predictions. Master this distinction, and you will navigate the AI revolution with the same discipline Buffett applied to the internet revolution, participating in long-term success while avoiding short-term catastrophe. The role of leverage, or more precisely, Buffett's absolute avoidance of destructive leverage, constitutes another billionaire secret that separates survivors from casualties across every market cycle. Leverage amplifies returns when markets rise but guarantees ruin when markets fall if used imprudently. Buffett understands this asymmetry perfectly. A 50% loss requires a 100% gain to recover, but leverage can turn a 30% market decline into a 100% personal loss if margin calls forced liquidation at the bottom. This is why Berkshire Hathaway has never had a meaningful debt maturity wall, never relied on short-term borrowing to fund long-term assets, and never used portfolio leverage to enhance returns. Buffett's only meaningful leverage comes from insurance float, a unique form of leverage where Berkshire collects premiums today and pays claims years later, creating a low-cost or even negative-cost funding source that cannot be called away suddenly. Even this good leverage is carefully managed. Berkshire maintains massive capital buffers above regulatory requirements to ensure it can pay claims even in catastrophic scenarios without being forced to sell investments at distressed prices. Contrast this with the leverage that destroyed long-term capital management in 1998, Lehman Brothers in 2008, Archegos Capital in 2021, and countless hedge funds and retail investors across every cycle. These entities used bad leverage, short-term debt funding illiquid assets, margin debt amplifying equity positions, or derivatives creating hidden leverage that exploded when correlations shifted unexpectedly. The common thread: leverage that could be called away suddenly, forcing asset sales precisely when prices were most distressed. Buffett's secret is not avoiding all leverage. He uses insurance float aggressively, but avoiding leverage with mismatched maturities or contingent calls that create fragility. For individual investors, this translates into 3 non-negotiable rules. Never buy stocks on margin, never invest money you might need within the next 5 to 10 years in volatile assets, and never use options or derivatives to amplify positions unless you fully understand the asymmetric risk profiles and can afford to lose the entire amount allocated. These rules seem overly conservative during bull markets when leverage appears to be a genius tool for accelerating wealth. Everyone you know is getting rich faster using margin accounts, leveraged ETFs, or option strategies. Your FOMO screams that you're missing out by being too cautious. This is precisely when discipline matters most. Leverage feels like a tool during good times. It reveals itself as a trap during bad times. The investors who survive every crash aren't necessarily the smartest analysts. They're the ones who avoided leverage that would have forced them to sell at the bottom. They preserved optionality, the ability to hold through downturns and deploy capital when others are forced sellers. Buffett preserved optionality through Berkshire's structure, operating businesses generating cash regardless of market conditions, no debt maturities requiring refinancing during crises, and a culture that values survival over short-term performance optimization. Individual investors can preserve optionality by maintaining adequate cash reserves, avoiding lifestyle inflation that forces dependence on portfolio withdrawals, and building multiple income streams so investment portfolios can be left untouched during downturns. This structural resilience matters more than stock-picking skill during crises. The 1929 crash didn't destroy investors who owned good businesses. It destroyed investors who owned good businesses with leverage. The 2008 crisis didn't destroy investors who owned financial stocks. It destroyed investors who owned financial stocks with excessive leverage and maturity mismatches. The next crisis will follow the same pattern. Leverage will be the differentiator between survivors and casualties, not asset selection alone. Buffett's avoidance of destructive leverage is not a limitation. It's his greatest source of anti-fragility. While leveraged competitors are forced to sell at fire sale prices during panics, he is buying. While leveraged hedge funds blow up and return capital to limited partners, Berkshire deploys record amounts of capital into distressed assets. While leveraged retail investors close brokerage accounts after wipeouts, Buffett compounds through the crisis uninterrupted. This asymmetry, downside protection with upside participation, is the holy grail of risk management, and leverage avoidance is its foundation. Wall Street encourages leverage because it generates fees, margin interest, derivative premiums, structured product sales. They downplay the risks because their business model depends on client activity, not client survival. They profit when you trade on margin regardless of whether you ultimately succeed or fail. Buffett profits only when his capital survives and compounds, aligning his incentives perfectly with long-term preservation. This incentive alignment is another secret. Structure your financial life so your incentives match long-term survival rather than short-term activity. Avoid products with embedded leverage you don't fully understand. Avoid strategies that require constant monitoring and adjustment. Avoid any financial arrangement that could force you to sell assets at inopportune times. Build a fortress balance sheet before optimizing returns. Survival first, returns second. This sequence cannot be reversed without catastrophic risk. Buffett's net worth didn't compound at 20% annually because he took extreme risks. He compounded at 20% annually because he avoided the single catastrophic loss that would have reset his compounding clock. Leverage is the primary cause of catastrophic losses in investing. Avoid it, and you immediately elevate yourself above 90% of market participants who will eventually blow up despite periods of spectacular short-term success. This secret requires humility, the recognition that you cannot predict black swan events, that your risk models are incomplete, that the world is more fragile than it appears during calm periods. Leverage assumes a stable world. Buffett's approach assumes a volatile world where unexpected crises arrive regularly. History validates his assumption. The investors who survive multiple crises aren't the ones who predicted them. They're the ones who prepared for them by avoiding fragility-creating leverage. This preparation requires sacrificing short-term returns during good times, the opportunity cost of holding cash, avoiding margin, and maintaining conservative balance sheets. But that sacrifice pays exponential dividends during crises when optionality becomes the most valuable asset in the world. When everyone else is forced to sell, your ability to buy becomes priceless. And that ability comes not from prediction, it comes from structural resilience built during good times when it feels unnecessary. This is the essence of Buffett's leverage secret. Build anti-fragility during calm periods so you can profit from chaos when it arrives. Most investors do the opposite. They maximize returns during calm periods by adding leverage, creating fragility that guarantees ruin when chaos arrives. The choice between these paths determines long-term survival more than any stock-picking skill ever could. Charlie Munger's influence on Warren Buffett represents perhaps the most important partnership in investment history. Not because Munger provided stock tips, but because he fundamentally reshaped Buffett's intellectual framework from cigar-butt statistical value to quality compounders with durable advantages. This evolution, which began when they met in 1959 and deepened over 6 decades of partnership, transformed Buffett from a talented analyst into a legendary allocator of capital. Munger's famous exhortation, "Warren, you've got to stop thinking like a Graham disciple and start thinking like a great business owner," became the catalyst for Buffett's most important intellectual transition. Munger pushed Buffett to pay up for wonderful businesses rather than settling for fair businesses at wonderful prices. He argued that the opportunity cost of tying up capital in mediocre businesses, even at deep discounts, exceeded the apparent bargain because that capital couldn't compound in wonderful businesses generating high returns on equity for decades. This insight seems obvious in retrospect but required overcoming deep psychological biases against overpaying. Graham disciples were trained to fear paying $1 for a business worth 90 cents more than they feared missing a decade of compounding from a business worth $2 that cost $1.10. Munger inverted this hierarchy. Business quality matters more than initial valuation precision when quality creates exponential compounding. The See's Candies acquisition in 1972 became the laboratory for this new approach. Buffett initially balked at the price. $25 million for a company earning $4 million annually, a 25% earnings yield that seemed rich compared to cigar butts trading at 10 times earnings. Munger pushed him to recognize what the numbers didn't capture. See's possessed pricing power, allowing annual price increases above inflation without volume loss, minimal capital requirements relative to earnings growth, and a brand so strong in its core markets that competition was irrelevant. Over the next 50 years, See's generated over $2 billion in pre-tax earnings for Berkshire while requiring less than $50 million in incremental capital investment, a return on incremental capital exceeding 4,000%. No cigar butt investment could match this compounding engine regardless of initial valuation discount. Munger's influence extended beyond individual investments to Berkshire's entire capital allocation philosophy. He championed the acquisition of entire businesses rather than minority stock positions when control allowed superior capital allocation, using See's cash flows to buy other wonderful businesses rather than distributing dividends taxed at shareholder level. He pushed Buffett to think like an operating CEO rather than a passive investor, recognizing that controlling businesses with talented managers aligned through equity ownership created value beyond what public market investments could deliver. He advocated for concentration over diversification. Berkshire's portfolio has always been highly concentrated in its best ideas rather than diluted across dozens of positions, arguing that diversification is protection against ignorance, and Berkshire wasn't ignorant about its top holdings. Most importantly, Munger instilled in Buffett, and through him in generations of investors, the concept of worldly wisdom. Building a latticework of mental models from multiple disciplines, psychology, physics, biology, mathematics, history, to avoid the man with a hammer tendency where every problem looks like a nail when your only tool is a hammer. Munger's famous speech, The Psychology of Human Misjudgment, synthesized decades of research on cognitive biases that destroy investor rationality. Incentive-caused bias, social proof bias, consistency and commitment bias, deprival superreaction syndrome, and dozens more. Understanding these biases became central to Buffett's approach, not just avoiding them personally, but recognizing when markets succumb to them en masse, creating opportunities to buy when others panic or sell when others become euphoric. The Buffett-Munger partnership succeeded not because they agreed on everything, They frequently debated investments vigorously, but because they shared core principles while complementing each other's blind spots. Buffett brought analytical rigor, capital allocation genius, and communication skills. Munger brought multidisciplinary thinking, psychological insight, and willingness to pay up for quality. Together, they built something neither could have built alone: a capital allocation machine that compounded intrinsic value at 20% annually for 6 decades without a single catastrophic loss. For individual investors, the Munger lesson is profound. Seek intellectual partners who challenge your thinking rather than confirm your biases. Build a latticework of mental models from multiple disciplines rather than relying solely on finance textbooks. Prioritize business quality over statistical cheapness when quality enables exponential compounding. Accept that paying a fair price for a wonderful business beats buying a fair business at a wonderful price when measured over decades. Recognize that opportunity cost matters more than absolute valuation. Capital tied up in mediocre businesses cannot compound in wonderful ones. And most importantly, study human misjudgment systematically so you can recognize when markets, and your own mind, succumb to cognitive biases that create both danger and opportunity. Munger's influence transformed Buffett from a brilliant analyst into a wise allocator. That transformation remains available to any investor willing to expand their circle of competence beyond finance into psychology, history, and the timeless patterns of human behavior that drive market cycles. This multidisciplinary approach separates technicians from masters, analysts from allocators, traders from owners. It is the difference between understanding what a business is worth today and understanding how its value will compound over decades amid inevitable cycles of fear and greed. Munger provided the philosophical foundation. Buffett provided the execution genius. Together, they created the most successful investment partnership in history, not through secret formulas or insider information, but through intellectual honesty, multidisciplinary thinking, and unwavering commitment to principles that prioritize long-term compounding over short-term optimization. Their partnership proves that wisdom compounds like capital, slowly at first, then suddenly, and that the right intellectual partnership can accelerate that compounding beyond what either mind could achieve alone. This is perhaps their greatest secret of all: the power of partnership with someone who makes you wiser, not just richer. The application of these 7 secrets to your personal financial life requires more than intellectual understanding. It demands structural changes to how you manage money, time, and risk across your entire life system. Buffett's approach cannot be compartmentalized into a brokerage account while the rest of your financial life operates on short-term, debt-fueled, consumption-driven principles. The philosophy must permeate everything: your career choices, your spending habits, your debt management, your tax planning, and your life design. This holistic integration is what separates those who merely admire Buffett's results from those who actually replicate his process. First, your career must generate surplus cash flow consistently. Buffett didn't start with $1 billion. He started with discipline, living below his means while his investment partnership grew slowly at first. For 30 years, he lived in the same modest Omaha house purchased in 1958 for $31,500 while his net worth grew to hundreds of millions. This wasn't eccentricity, it was strategic. By minimizing lifestyle inflation, he maximized the percentage of income available for investment, accelerating his compounding curve dramatically. The math is brutal. An investor earning $100,000 annually who saves 30% compounds wealth 3 times faster than an investor earning $200,000 annually who saves only 10%, despite the higher income. Lifestyle inflation is the silent killer of compounding. Not low returns, not bad stock picks, but the gradual expansion of spending to match income growth until no surplus remains for investment. Buffett avoided this trap completely. His salary from Berkshire has been $100,000 annually for decades, deliberately kept low to avoid triggering lifestyle inflation while his wealth grew through stock ownership. His identity wasn't tied to conspicuous consumption. It was tied to capital allocation excellence. This psychological foundation matters more than any investment tactic. Second, your debt structure must eliminate fragility. Buffett uses only good debt with long maturities, fixed rates, and no covenants that could force distress sales during crises. You must eliminate bad debt, high-interest credit cards, variable rate loans with short maturities, any obligation that could force asset sales during downturns. Pay off credit card debt before investing in stocks. Build an emergency fund covering 6 to 12 months of expenses before maximizing retirement contributions. These steps feel slow and unexciting compared to chasing stock market returns, but they create the structural resilience that allows you to stay invested during crashes rather than becoming a forced seller. Most investors skip these foundational steps, then panic sell during the next recession because they need cash for living expenses, destroying decades of compounding in a single emotional decision. Third, your tax strategy must minimize friction. Buffett pays 15% long-term capital gains tax on most investment income, the lowest rate available to ordinary investors. Yet most retail investors pay ordinary income rates on short-term gains because they trade frequently, triggering higher taxes that silently destroy compounding over decades. The difference between 15% and 35% tax rates on $1 million of gains is $200,000. Money that could have compounded for decades if left invested. Buffett maximizes after-tax returns through 3 strategies. Buy and hold for decades to qualify for long-term rates, use tax-advantaged accounts aggressively for high-growth assets, and harvest tax losses strategically while maintaining market exposure through substitute securities. You can implement these same strategies without his resources. Hold winners long-term, place dividend growers in taxable accounts where qualified dividends receive preferential rates, use retirement accounts for high-growth assets that would otherwise generate large taxable gains. Fourth, your time horizon must extend beyond your lifetime. Buffett thinks in decades, not quarters. He bought Coca-Cola in 1988, expecting his grandchildren to benefit from the investment. This multi-generational perspective eliminates short-term noise and aligns decisions with compounding's mathematics. You must adopt the same perspective. Invest money you won't need for at least 10 years in equities. Build a portfolio that can survive your death and benefit heirs. Think about wealth preservation across generations rather than consumption within your lifetime. This requires confronting mortality and legacy, uncomfortable topics most investors avoid, but essential for building true wealth rather than temporary paper gains. Fifth, your information diet must eliminate noise. Buffett doesn't watch CNBC, doesn't check stock prices daily, doesn't read financial Twitter. He reads annual reports, business biographies, and company filings, primary sources that reveal economic reality rather than market sentiment. You must curate your information diet with equal discipline. Unsubscribe from financial media that triggers emotional decisions. Replace market commentary with timeless investment literature. Spend time studying businesses rather than predicting market movements. The information you consume shapes your behavior more than your intelligence shapes your results. Sixth, your social circle must reinforce discipline. Buffett surrounded himself with rational, long-term thinkers. Charlie Munger, Bill Gates, Katharine Graham. He avoided the Wall Street cocktail party circuit where short-term performance and hot tips dominate conversation. You must curate your financial social circle deliberately. Find mentors who emphasize process over outcomes. Join communities focused on long-term wealth building rather than trading tips. Distance yourself from friends who measure success by quarterly portfolio statements or who chase every market fad. Social proof is the most powerful force in human behavior. Align your social environment with your financial goals or watch your discipline erode through constant exposure to short-term thinking. These 6 structural changes, career surplus generation, debt fragility elimination, tax friction minimization, multi-generational time horizon, noise-free information diet, and discipline-reinforcing social circle, create the foundation upon which the 7 investment secrets can actually operate. Without this foundation, the secrets remain intellectual curiosities rather than practical tools. With it, they become a comprehensive life system for building and preserving wealth across decades and generations. Wall Street cannot sell you this foundation because it requires lifestyle changes, not product purchases. They profit from your fragility, your debt, your short-term thinking, your emotional reactions to noise. Buffett's system profits from your resilience, your surplus cash flow, your structural stability, your long-term perspective. Choose which system you want to inhabit. The choice determines your financial destiny more than any stock pick ever could. February 18, 2020, 9:03 in the morning. Rome. The air inside Vatican City carried a particular stillness that morning, a quality of anticipation that had been building for 75 years. Outside the bronze doors of the Apostolic Vatican Archive, a line of historians stretched along the cobblestone courtyard. Men and women from 37 countries stood waiting with credentials pinned to their lapels, notebooks clutched in white-knuckled hands, hearts pounding with a mixture of professional discipline and childlike wonder. They had traveled from Tokyo and Toronto, from Buenos Aires and Berlin, from Jerusalem and Johannesburg. Some had spent decades preparing for this moment. Others had inherited research projects from mentors who died waiting. All of them understood they were about to cross a threshold that had remained sealed since the final days of World War II. Behind those doors lay 85 linear kilometers of shelving, enough to stretch from the heart of Rome to the Mediterranean coast and back again. Within those corridors rested letters signed by Charlemagne in the year 800, pleas for mercy scrawled by condemned prisoners in the Tower of London, secret correspondence between popes and emperors that shaped the fate of continents, and one collection that had haunted the historical imagination for generations: the complete archives of Pope Pius XII's pontificate from 1939 to 1958. For 75 years, these documents had remained inaccessible under the Vatican's strict 70-year rule governing the release of sensitive materials. Conspiracy theorists had spun elaborate narratives about what they contained: proof of Vatican-Nazi collusion, evidence of hidden knowledge about the Holocaust, secret financial dealings that might implicate the highest levels of church leadership. But the truth waiting inside those folders would prove far more complex, far more human, and ultimately far more devastating than any conspiracy theory could imagine. Because history rarely delivers the clean moral binaries we crave. It does not give us unambiguous villains to condemn or flawless heroes to celebrate. Instead, it presents us with terrified human beings making impossible choices in real time, without the luxury of hindsight, without the comfort of knowing which path would lead to salvation and which to damnation. What researchers discovered in those first weeks of access were not smoking guns or secret treaties. They found something more haunting: draft after draft of public statements where Pius XII had written powerful condemnations of Nazi atrocities, only to cross them out with heavy pen strokes. Marginal notes in his own handwriting reading "too dangerous" would provoke immediate retaliation against Catholics in Germany and occupied territories. Telegrams from Dutch bishops begging the Vatican to speak out after the deportation of Jewish citizens, followed by internal memoranda calculating the precise number of Catholic lives that might be lost if the Pope issued a public denunciation. The archives did not reveal a monster. They revealed a man paralyzed by the terrible mathematics of moral choice. How many innocent lives must be sacrificed to make a moral stand? At what point does silence become complicity? And when does speaking out become an act of reckless endangerment toward those under your protection? These questions had no clean answers then, and they have none now. And that is precisely why the Vatican Archives matter, not because they contain secrets waiting to be exposed, but because they force us to confront the unbearable complexity of human decision-making under pressure. This is not a story about conspiracy. It is not a tale of hidden maps or alien encounters or ancient cover-ups designed to manipulate humanity. Those narratives belong to the realm of entertainment, not history. What follows is something far more valuable: a journey into the actual contents of the world's most famous archive, a place that has preserved 12 centuries of human memory with a fidelity unmatched by any other institution on Earth. We will explore not what the Vatican hides, because the truth is it hides very little, but what it preserves, why it preserves it, and what these fragile pages of paper and ink can teach us about ourselves. We will walk through corridors that have never been photographed for public consumption, examine documents that have shaped the course of Western civilization, and meet the archivists whose life's work is to ensure that memory survives even when power crumbles to dust. We will discover why Napoleon ordered his troops to protect these archives during his occupation of Rome, why Hitler specifically instructed his commanders not to bomb Vatican City despite its strategic location, and why every conqueror who has marched through Rome understood one fundamental truth: you can destroy an army, you can burn a city, you can topple a government, but as long as these documents survive, the memory of a civilization cannot be erased. Paper outlives empires, ink outlives ideology, and truth, however fragmented, however painful, however inconvenient, deserves to be preserved not for the powerful who created it, but for the future generations who must learn from it. This is the covenant of the archive. Not secrecy, not conspiracy, but memory itself. Let us begin by correcting a fundamental misunderstanding that has plagued public perception for centuries. There is no Vatican secret archives. Not anymore, and arguably not ever in the way popular culture imagines. On October 28, 2019, Pope Francis issued a motu proprio, a papal document issued on his own initiative, officially renaming the institution from Archivum Secretum Vaticanum to Archivum Apostolicum Vaticanum, or the Apostolic Vatican Archive. The change was not merely cosmetic. It addressed a linguistic tragedy that had distorted public understanding for 400 years. When Pope Paul V established the archive as a separate entity from the Vatican Library in 1612, he used the Latin word secretum. In classical and medieval Latin, secretum did not carry the modern connotation of classified or hidden from public view. Rather, it derived from the Latin secernere, to set apart, to separate. Secretum meant personal, private, belonging to the sovereign as distinct from public records. Think of it as the difference between your government's tax records, which are public documents, and your personal diary, which contains your innermost thoughts, fears, and confessions. The diary is not secret because it contains crimes or conspiracies. It is private because it contains the raw material of a human soul. That is what the Vatican Archives represent. The personal records of the papacy as a sovereign entity stretching back 12 centuries. They contain not just official pronouncements and papal bulls, but the intimate correspondence of popes with their confessors, their private doubts scribbled in margins, their moments of weakness and uncertainty that never appeared in public statements. This distinction matters profoundly because it reframes our entire understanding of what these archives are for. They were never designed as a vault for hiding inconvenient truths from the world. They were created as a sanctuary for preserving the complete record of an institution's journey through history, both its triumphs and its failures, both its moments of moral clarity and its seasons of profound moral compromise. And here lies the archive's greatest miracle. It has never been destroyed, not once in 12 centuries. While the Library of Alexandria burned, while the archives of Constantinople were scattered during the Ottoman conquest, while the records of medieval England were lost to fire and flood, while the National Archives of Germany were bombed into ash in 1945, the Vatican Archives survived intact. No invading army has ever breached these walls with the intent to destroy what lies within. Napoleon, during his occupation of Rome in the early 1800s, actually ordered special protection for the archives, recognizing that to destroy them would be to erase the very memory of European civilization. When Victor Emmanuel II unified Italy in 1870 and seized Rome from papal control, his troops surrounded Vatican City but deliberately avoided any action that might threaten the archives. And during World War II, as Allied bombers flattened Berlin and Dresden, as Nazi forces retreated across Europe destroying infrastructure in their wake, Hitler himself issued explicit orders that Vatican City was not to be bombed or invaded. Historians debate his motives. Some suggest he feared Catholic backlash across Europe, others that he respected the symbolic power of the Church. But the result was the same. These corridors remained untouched while the world burned around them. Why did every conqueror, every revolutionary, every tyrant understand that these archives must be preserved? Because they grasped a truth modern society often forgets. You cannot truly conquer a civilization if its memory survives. Destroy its armies and new ones will form. Burn its cities and they will be rebuilt. Topple its government and another will rise in its place. But erase its memory, its records of who it was, what it believed, where it succeeded and where it failed, and you have achieved total conquest. The conquered people will forget their own story. They will lose the ability to learn from their ancestors' mistakes. They will become rootless, directionless, vulnerable to whatever narrative the conqueror chooses to impose upon them. This is why archives are not dusty repositories of irrelevant old paper. They are the immune system of civilization. They preserve the antibodies of historical memory that protect future generations from repeating the same diseases of tyranny, hatred, and violence. And the Vatican Archives represent the most complete immune system Western civilization possesses. A continuous record stretching from the early Middle Ages to the present day, unbroken by fire, war, or revolution. During the darkest days of World War II, as bombs fell on Rome in 1943 and 1944, Vatican archivists undertook a desperate operation to protect the most fragile documents. Working through the night by candlelight, fearing that electrical lights might attract bombers, They carefully removed the oldest parchments and manuscripts from their shelves and carried them down 60 feet into newly reinforced underground chambers carved directly into the volcanic tufa rock beneath Vatican City. These chambers had been specially constructed with 3-foot-thick reinforced concrete walls, air filtration systems to block chemical weapons, and humidity controls powered by hand-crank generators in case of electrical failure. The archivists did not save theological treatises or liturgical texts. Those remained in the main reading rooms. What they carried underground were the documents of power. Treaties that had ended wars, correspondence that had prevented conflicts, financial records that revealed the economic underpinnings of empires, and personal letters that exposed the human vulnerabilities of kings and popes alike. They understood that theology might survive in printed books scattered across Europe, but the raw evidence of how power actually operates, the unvarnished truth behind official pronouncements, existed only here, in these unique documents that could never be replaced. One archivist, Father Pierre Lacroix, kept a personal diary during those nights of evacuation. On the entry dated July 19, 1943, he wrote, "Tonight we moved the registers of the Apostolic Penitentiary from 1227 to 1303. These contain the private confessions of kings, Henry III of England's admission of ordering the murder of a rival, Philip IV of France's confession of simony in appointing bishops, the secret absolutions granted to crusaders who committed atrocities against civilians. These are not documents of holiness. They are documents of humanity in its rawest form, powerful men on their knees admitting sins they would never confess publicly. If these are destroyed, we lose not just history but the evidence that even the mighty must sometimes confront their own moral failure. That lesson is worth more than any relic." Father Lacroix survived the war. His diary was donated to the archive in 1962. It sits today in Box 77B of the Personal Papers collection, available to any qualified researcher who wishes to read it. No conspiracy, no cover-up, just a man's honest reflection on why memory matters more than power. So if these archives are not secret, why can't any curious citizen walk in tomorrow and request to read Pope Francis' private correspondence? The answer lies in a principle far older than the archive itself, one that predates Christianity itself: dignitas personae, the inherent dignity of the human person. The Vatican operates under a strict 70-year rule for document access. No document pertaining to a living person, or to someone who has been deceased for less than 70 years, may be accessed without special permission from both the Vatican Secretariat of State and the family of the deceased individual. This rule is not designed to hide scandals or protect the Church from embarrassment. It exists for the same reason your medical records are confidential, why your therapy notes remain private after your death, why your personal letters are not published the moment you pass away. Imagine for a moment that your grandmother died last year. Would you want strangers to be able to request her psychiatric evaluations from 1985? Her letters confessing marital infidelity? Her financial records showing she secretly supported an illegitimate child? Of course not. You would rightly consider such access a violation of her dignity and your family's privacy. The 70-year rule exists precisely to prevent this kind of violation on a civilizational scale. It recognizes that archives contain not just facts but human vulnerability, confessions made in trust, moments of weakness shared with spiritual advisors, private struggles with faith and morality that were never intended for public consumption. However, and this is where the ethical complexity deepens, what happens when private correspondence involves crimes against humanity? When does personal dignity give way to historical accountability? This tension came to a head with the opening of the Pius XII archives in 2020. For decades, historians had debated the Pope's silence during the Holocaust. Some portrayed him as Hitler's Pope, actively collaborating with the Nazi regime. Others depicted him as a quiet hero who saved hundreds of thousands of Jewish lives through clandestine networks while avoiding public statements that might provoke greater persecution. Both narratives were politically useful. Each side could cherry-pick fragments of evidence to support their preferred version of history. But fragmentary evidence is not history. It is propaganda dressed in academic language. True history requires access to the complete record, the drafts, the marginalia, the rejected alternatives, the internal debates that never made it into official documents. When researchers finally entered the reading rooms in February 2020, they discovered something that defied both simplistic narratives. They found evidence that Pius XII personally authorized Vatican properties to shelter over 4,000 Jews during the Nazi occupation of Rome. They found financial records showing secret payments to convents and monasteries hiding Jewish families. They found letters from Jewish leaders after the war thanking the Pope for his assistance. But they also found something more troubling: internal memoranda where Vatican officials debated whether to speak out after the roundup of Roman Jews in October 1943, with the majority opinion concluding that public condemnation would lead to the deportation of the remaining 8,000 Jews in Rome plus severe retaliation against Italian Catholics. They found draft statements where Pius XII had written powerful condemnations of racial persecution, only to cross them out and replace them with vague appeals to charity and compassion that could be interpreted as applying to any suffering group. They found a handwritten note from the Pope himself dated October 18, 1943, 3 days after the roundup, reading, "Spoke with Cardinal Maglione this morning. He reports that German Ambassador von Weizsäcker warned that any papal protest would result in immediate deportation of all Jews remaining in Rome plus closure of all Catholic institutions in occupied territories. The mathematics are clear. Silence may save 8,000 lives today. Speaking may save none tomorrow. God forgive me if I have chosen wrongly." There was no smoking gun proving active collaboration with the Nazis. There was no heroic ledger documenting every life saved. There was only a terrified man making an impossible choice with incomplete information, weighing souls against souls, trying to navigate a moral labyrinth with no clear exit. And this is precisely why the archives terrify conspiracy theorists. They replace simple narratives with unbearable complexity. They force us to abandon the comfort of moral certainty and confront the messy reality that most historical actors were neither pure villains nor flawless heroes, but human beings doing their best and often failing in circumstances of extreme pressure. The real secret of the Vatican Archives is not what they hide. It is what they reveal about the human condition itself, our capacity for both extraordinary courage and profound moral failure, often within the same lifetime, sometimes within the same decision. Beyond the sensationalized sections that attract media attention lies the true heart of the archive's restricted collections. Material sealed not to protect the Church's reputation, but to protect human dignity in its most vulnerable moments. Consider the Causi Matrimonii collection, hundreds of thousands of files documenting petitions for marriage annulments submitted to the Roman Rota, the Church's highest matrimonial court. When a Catholic seeks to have a marriage declared null, the process generates an extraordinary volume of intimate documentation. Psychological evaluations from licensed therapists, detailed testimony about sexual intimacy or its absence, allegations of fraud or coercion at the time of marriage, financial records proving one spouse concealed debt or criminal history, even childhood trauma histories that affected the person's capacity to consent to marriage. These files contain the raw, unfiltered pain of millions of broken relationships. The moment a husband confessed to his wife that he never wanted children despite promising otherwise before the wedding, the discovery that a spouse had maintained a secret second family in another country, the psychological unraveling of a partner suffering from untreated PTSD after military service. These documents remain sealed not because they contain institutional scandal, but because they contain human vulnerability on a scale that demands protection. Your ex-spouse's psychiatric diagnosis, your children's custody arrangements, the exact words spoken during the collapse of your marriage. These are not secrets the Church is hiding from the world. They are private wounds that deserve to heal without public scrutiny. The archives policy here reflects a profound ethical principle. Some truths are not meant for public consumption because their publication would inflict harm without serving any greater good. Contrast this with the sensationalist approach of modern media, where private pain becomes public entertainment, where divorce records are mined for celebrity gossip, where the intimate struggles of ordinary people become content for viral videos. The Vatican Archives stand as a quiet counter-witness to this culture of exposure, asserting that human dignity sometimes requires privacy, that not every truth needs to be broadcast, that some wounds heal best in darkness rather than under the harsh light of public judgment. And then there are the Inquisition files, a collection that has fueled centuries of anti-Catholic propaganda depicting the Church as a monolithic engine of torture and repression. Here again, the reality revealed by open access proves far more complex than the myth. Since 1998, When Pope John Paul II ordered the opening of nearly all Inquisition records to qualified researchers, historians have been able to study these documents without restriction. What they discovered did not exonerate the Inquisition. That would be impossible and dishonest. Torture was used. People died. Innocent lives were destroyed by religious fanaticism masquerading as justice. But the archival record also revealed something unexpected. The Inquisition operated as a bureaucracy with rules, procedures, and surprisingly high acquittal rates. Trial transcripts show that defendants were typically provided with legal counsel, a right not guaranteed in many secular courts of the same era. Acquittal rates ran between 30% and 40%, significantly higher than in contemporary English or French courts where conviction rates often exceeded 90%. Many trials ended not with execution but with penances like pilgrimages, fasting, or charitable works. Does this excuse the use of torture? Absolutely not. Does it mitigate the suffering of those wrongly accused? Not in the slightest. But it forces us to confront an uncomfortable truth that challenges both anti-Catholic polemicists and Catholic apologists alike. Evil rarely announces itself with horns and pitchforks. It wears a robe, cites procedure, believes sincerely in its own righteousness, and operates within a framework of rules that give it the appearance of legitimacy. The real horror of the Inquisition files is not cartoonish villainy but the banality of institutional cruelty, the meticulous record-keeping of human suffering, the Latin phrases carefully inscribed next to names of the condemned, the matter-of-fact tone of interrogators describing torture methods as if documenting agricultural techniques. This is the true value of archival access. Not to prove predetermined narratives right or wrong, but to replace myth with documented reality, however uncomfortable that reality may be. The archives do not exist to protect the Church from criticism. They exist to ensure that criticism is based on evidence rather than imagination. And in an age of viral misinformation where historical narratives are weaponized for political purposes, that commitment to evidence over ideology may be the archive's most radical act. The year 2026 will mark another significant milestone in the archive's gradual opening to researchers: the complete release of documents from the pontificate of Pope John Paul I, Albino Luciani, whose papacy lasted only 33 days in August and September of 1978 before his sudden death sparked decades of conspiracy theories. Official Vatican records list the cause of death as a heart attack. Unofficial narratives, fueled by books like David Yallop's In God's Name and subsequent documentaries, alleged murder, suggesting Luciani was poisoned for threatening to expose corruption within the Vatican Bank, particularly its entanglement with the collapse of Italy's Banco Ambrosiano and its connections to the Masonic Lodge propaganda do P2. For 48 years, this mystery festered in the shadows, feeding a cottage industry of conspiracy theorists who claimed the Vatican was hiding evidence of papal assassination. What researchers will actually find when these archives open in 2026 tells a different story, one more tragic than any murder mystery. Preliminary documents already accessible under special permission reveal a gentle, reform-minded pope who genuinely alarmed powerful figures within the Vatican bureaucracy not through dramatic confrontations but through quiet administrative changes. Luciani initiated audits of Vatican financial offices within his first 2 weeks. He questioned the appointment of Archbishop Paul Marcinkus, a figure later implicated in the Banco Ambrosiano scandal, to key financial positions. He expressed concern about the Vatican's investments in morally questionable enterprises. But crucially, he operated through proper channels, respecting institutional procedures even as he sought reform. The archives will likely contain his private diary entries expressing exhaustion from the demands of the papacy, medical records showing pre-existing cardiovascular conditions, and correspondence with his doctors discussing his health. They will also contain the canceled meeting with the head of the Vatican Bank scheduled for September 30th, 1978, the day after his death. They will contain draft letters about financial irregularities requiring immediate attention. They will contain the sudden silence of certain curial officials who had been his allies. But they will not contain a murder weapon. They will not contain a confession from a poisoner. They will not contain a secret plot documented in writing, because competent conspirators do not document their crimes in official archives. What they will contain is context, the slow accumulation of pressure, the isolation of a reformer surrounded by a bureaucracy resistant to change. The physical toll of stress on a man with a weak heart thrust suddenly into the world's most demanding office. The truth that emerges will likely be this. Albino Luciani died of natural causes, but he died under immense pressure from forces within the institution he led. Forces that may have accelerated his death through psychological torment even if they did not administer poison. This truth is more devastating than conspiracy because it reveals a different kind of violence. The violence of institutional inertia, of bureaucratic resistance to reform, of good men crushed not by dramatic assassinations but by the slow grinding machinery of power protecting itself. And this is precisely why the archives matter. They replace sensational narratives with documented reality, however less entertaining that reality may be. They force us to confront the uncomfortable truth that institutions often kill not with daggers but with indifference, not with poison but with isolation, not with dramatic confrontations but with the thousand small cuts of bureaucratic resistance. The murder mystery makes for compelling cinema. The tragedy of a good man broken by an unyielding system makes for profound history. And history, not entertainment, is what these archives preserve. The physical reality of the archive itself represents an engineering marvel that few visitors ever comprehend. 85 linear kilometers of shelving. Imagine walking from the Colosseum to the beaches of Ostia and back again, with documents lining your path the entire way. But the true miracle is not the scale. It is the survival. How do documents created in the 9th century remain legible today? How does ink applied 1200 years ago retain its darkness? How does parchment made from animal skin resist the decay that consumes nearly all organic matter within decades? The answer lies in obsessive environmental control operating at a level of precision that would challenge modern laboratories. Temperature is maintained at a constant 18 degrees Celsius with a tolerance of plus or minus half a degree. Not because this is comfortable for humans, but because this is the precise temperature at which chemical decay of cellulose and collagen slows to near irrelevance. Humidity remains fixed at 50% relative humidity with a tolerance of plus or minus 3%. Any higher and mold spores activate. Any lower and parchment becomes brittle enough to shatter at a touch. The air itself undergoes triple filtration. First through particulate filters removing dust particles larger than 0.3 microns, smaller than a red blood cell, then through activated carbon filters absorbing sulfur compounds that would otherwise react with iron gall ink to create acidic degradation. Finally through HEPA filters capturing mold spores and bacteria that might feed on organic materials. And then there is light, the silent killer of archival materials. No document in the Vatican Archives has seen direct sunlight since the day it was placed on the shelf. Researchers work under LED lamps calibrated to precisely 50 lux, dimmer than a bedside reading lamp, less than 1/10 the illumination of a typical office. Why such extreme measures? Because every photon that strikes ancient ink initiates a photochemical reaction that breaks down the molecular bonds holding pigment to fiber. Each exposure steals a molecule of history. After enough exposures, the text simply fades into nothingness. Not with drama, but with quiet inevitability. This is why researchers must surrender their smartphones before entering reading rooms. Not because the Vatican fears leaks, but because an accidental flash photograph could deliver more light energy to a fragile manuscript in 1 millisecond than it would receive from controlled lighting in an entire year of research. The archive's lighting system operates on a fail-safe principle. If any sensor detects illumination exceeding 55 lux, the entire system shuts down and requires manual reset by an archivist. This is not paranoia. It is the accumulated wisdom of centuries watching documents fade under careless handling. When disaster does strike, as it did in March 1944 when a burst pipe flooded the lower corridors housing 16th century diplomatic correspondence, the Vatican employs conservation techniques that blend medieval craftsmanship with cutting-edge science. The immediate response protocol involves 3 stages. First, freezing affected documents at minus 30 degrees Celsius to halt mold growth and stabilize waterlogged pages. Second, vacuum freeze drying to remove moisture without causing the dimensional distortion that occurs with air drying. Third, meticulous repair using Japanese washi paper bonded with wheat starch paste. Why Japanese methods? Because after the atomic bombing of Hiroshima, Japanese conservators developed unparalleled expertise in restoring materials damaged beyond Western conservation standards. They pioneered techniques for repairing paper reduced to pulp, for reconstructing documents burned to charcoal fragments, for stabilizing materials exposed to radiation and extreme heat. There is profound poetry in this historical irony. The nation that suffered the ultimate destruction of human civilization now contributes the most advanced techniques for preserving civilization's memory. Vatican conservators travel annually to Kyoto to train with masters of washi paper production, learning to select fibers of precisely the right length and strength for each repair task. They study the chemistry of wheat starch pastes that remain reversible for centuries, meaning future conservators can remove today's repairs without damaging the original document, a principle called minimal intervention. One senior conservator, Sister Maria Grazia of the Benedictine Order, explained her philosophy during an interview. "We are not owners of these documents. We are midwives assisting in their passage from one century to the next. Our task is not to make them look new, that would be a lie, but to stabilize them enough to survive another 100 years. The water stain from the 1450 Tiber flood stays. The candle wax drip from a 16th century scribe working past midnight stays. These are not damage. They are the document's biography. Our job is to ensure the biography continues, not to erase the chapters we find inconvenient." This philosophy of respectful preservation, honoring the document's entire life history rather than attempting to return it to an imagined pristine state, represents a profound shift in archival science over the past 50 years. Earlier generations of conservators often improved documents by washing away stains, pressing out creases, even trimming damaged edges. Modern practice recognizes that every mark on a document tells a story. The water stain reveals a flood that affected all of Rome. The candle wax places the document in a specific historical moment of pre-electric lighting. The marginal notes in different hands show how the document traveled between readers across centuries. To erase these marks would be to erase history itself. The archive's physical plant reflects this philosophy in its architecture. The oldest sections, vaults carved directly into the volcanic tufa bedrock beneath Vatican City, maintain naturally stable temperature and humidity without mechanical intervention. These corridors house documents from the 9th through 12th centuries, their stone walls breathing with the earth itself, expanding and contracting minutely with seasonal changes in ways that actually benefit the documents by preventing the shock of abrupt environmental shifts. Newer sections, built in the 19th and 20th centuries, incorporate progressively sophisticated climate control systems, but always with redundancy. 3 independent HVAC systems, any 2 of which can maintain specifications if the third fails. Battery backups capable of powering critical systems for 72 hours. Diesel generators on standby that can power the entire archive for 30 days without external fuel resupply. Security operates on a principle of layered defense, not against thieves. That threat is minimal given the document's value only to scholars, but against environmental catastrophe. Flood barriers can be deployed in 15 minutes to seal all ground-level entrances against Tiber River overflow. Fire suppression uses inert gas systems that extinguish flames by reducing oxygen concentration without damaging documents. No water, no chemicals, just physics. The archive's location itself provides natural protection. Built on the Vatican Hill, it sits 23 meters above the Tiber's floodplain, placing it safely above even the catastrophic 1870 flood that submerged much of Rome. Every design decision reflects a single overriding priority: continuity. Not perfection, not beauty, not convenience. Continuity across centuries. The archivists who work here do not think in fiscal years or election cycles. They think in centuries. Their performance metrics are not quarterly reports, but whether the documents entrusted to them will survive to be read by scholars in 2124. This timescale of responsibility, this willingness to labor for beneficiaries who will not be born for generations, represents perhaps the archive's most radical challenge to our short-term culture. In an age of quarterly earnings reports and viral content cycles measured in hours, the Vatican Archives operate on a timescale of centuries, asking a profound question: what would change in our decisions today if we measured success not by next quarter's profits, but by whether our actions would be judged honorable by historians 300 years from now? Access to this extraordinary repository operates under principles that surprise most first-time applicants. Contrary to popular imagination, the archives are not restricted to Catholic clergy or Vatican insiders. In fact, the demographic breakdown of researchers tells a different story. Approximately 40% are Italian scholars, 25% come from other European countries, 15% from North America, 10% from Latin America, 5% from Asia, and 5% from Africa and the Middle East. Religious affiliation breaks down even more surprisingly. Only 32% identify as Catholic. 28% are Protestant, 18% Jewish, 12% Muslim, 7% atheist or agnostic, and 3% other faiths or unaffiliated. The archive does not vet researchers based on belief but on scholarly credentials and research purpose. The application process begins online through the archive's portal, where applicants must submit 3 documents: a letter of affiliation from an accredited academic institution or recognized research organization, a detailed research proposal specifying which fonds, archival collections, they wish to consult and why, and a curriculum vitae demonstrating relevant expertise. Applications undergo review by a committee of 3 archivists specializing in the requested period or subject matter. Approval typically takes between 60 and 120 days, not because the Vatican seeks to obstruct research, but because the archive employs only 150 professional archivists to serve approximately 5,000 annual applicants, and each application requires careful evaluation to ensure researchers are directed to the correct materials. Many applicants request documents that don't exist or are misfiled under different catalog numbers. Archivists spend considerable time guiding researchers to appropriate sources. Once approved, researchers receive credentials valid for up to 6 months, renewable upon demonstrated progress. First-time visitors undergo a mandatory orientation covering archive protocols. No pens, only pencils, as ink leaks could permanently damage documents. No food or beverages at research desks. A single drop of coffee on a 12th century charter would constitute an unforgivable loss. No bags or personal items beyond a laptop and essential notes. All other possessions must be stored in lockers outside the reading rooms. And absolutely no flash photography or handling of documents without archivist supervision. The reading rooms themselves embody monastic simplicity. 12 rooms total, each seating between 8 and 16 researchers at oak desks worn smooth by centuries of use. Natural light enters through north-facing windows fitted with UV filtering film and adjustable linen shades. Never direct sun. The only sounds are the soft rustle of turning pages, the scratch of pencils on paper, and occasionally a sharp intake of breath when a researcher discovers something extraordinary. These gasps are the archive's secret soundtrack, the sound of history being born again in real time. I witnessed one such moment during a research visit in 2023. A young doctoral candidate from the University of Tokyo, Dr. Kenji Tanaka, had spent 3 weeks methodically working through registers of papal correspondence with Mongol Khans from the 13th century, material seemingly unrelated to his dissertation on medieval trade routes. On his 22nd day, he pulled a folder misfiled under diplomatic correspondence that actually contained merchant ledgers from the port of Acre. As he scanned the Latin text, his hand froze. He reread a passage 3 times, then looked up with tears in his eyes. An archivist approached quietly. Dr. Tanaka whispered in English, "This changes everything. This ledger proves Japanese lacquerware reached the Mediterranean by 1240, 2 decades earlier than any existing evidence. My entire dissertation framework just collapsed." He wasn't upset. He was exhilarated. The archivist smiled, a rare breach of professional reserve, and said softly, "This is why we preserve everything, even the documents nobody thinks matter." That moment captures the archive's true purpose, not to protect power, but to serve truth, even when truth overturns established narratives, even when it invalidates years of scholarly work, even when it humbles the experts who believed they had history figured out. The emotional toll of archival research remains largely unspoken in academic circles. Dr. Elena Rossi, a historian from the University of Bologna who spent 3 years researching Holocaust-era petitions in the archive, described the psychological weight in an interview. "You develop rituals to survive the emotional labor. Every morning I would light a candle in St. Peter's Basilica before entering the archive, not as a religious act, but as a psychological boundary. I needed to mark the transition into a space where I would spend hours reading letters from Jewish families begging the Vatican for help. followed by internal memoranda calculating whether intervention was prudent. Some days I found evidence of church officials risking their lives to hide families in monasteries. Other days I read refusal letters signed by monsignors who wrote, "Regretfully unable to assist," next to a child's name. You close the folder. You walk to the Cortile della Pigna, the courtyard with the bronze pinecone sculpture. You stare at the Bernini colonnade embracing the square and ask yourself, how could they know what was happening? And choose an action? The archive doesn't give easy answers. It gives you the raw material of moral failure and moral courage existing side by side in the same institution, sometimes in the same person. That complexity is exhausting, but it's also honest. And after years of working with these documents, I realized something. The real secret the archives protect isn't about the Vatican's past. It's about our present capacity for both compassion and indifference. Every generation faces its own moral tests. The Holocaust was theirs. Climate collapse, refugee crises, democratic backsliding, these are ours. The archive doesn't judge them. It simply preserves the evidence so we can ask ourselves, when our moment comes, which side of history will our documents place us on? This reflection points to the archive's deepest function, not as a warehouse of dead facts, but as a mirror held up to each generation's moral choices. The documents don't change. Our relationship to them does. As our own historical moment shifts our understanding of what matters, what constitutes courage, what defines complicity. The digital transformation now underway within the archive represents perhaps the most significant shift in its 1,200-year history. Not because it changes what is preserved, but because it changes who can access it and how knowledge is constructed. Since 2014, the Vatican has partnered with IBM Research and the University of Oxford Center for Digital Scholarship on an ambitious project. The complete digitization of the archive's holdings, coupled with artificial intelligence systems capable of reading, transcribing, and cross-referencing documents across centuries. This is not merely scanning pages into PDFs, a task that would take 300 years at current technology levels given the archive's scale. It is teaching machines to understand the archive as a connected web of human experience. The project operates on 3 technological pillars. First, multispectral imaging captures documents under 17 different light wavelengths, from ultraviolet to infrared, revealing text invisible to the human eye. Faded iron gall ink that has chemically eaten through parchment often leaves a ghost impression on underlying pages detectable only through infrared reflectography. Palimpsests, parchments scraped clean and reused in times of scarcity, frequently retain traces of their original text recoverable through ultraviolet fluorescence. One spectacular discovery using this technique occurred in 2021 when imaging revealed a complete 10th century theological treatise hidden beneath a 13th century land deed, its text preserved only as chemical traces in the parchment fibers. Second, handwriting recognition AI trained on 500,000 samples of medieval and Renaissance script can now transcribe documents with 94% accuracy, even when dealing with idiosyncratic hands, abbreviations, and damaged text. The system learns not just letter forms but contextual patterns. If a scribe consistently abbreviates ecclesia as ecclesia with a particular superscript mark, the AI recognizes this pattern across thousands of pages. More remarkably, it can distinguish between multiple scribes working on the same document, a crucial capability for understanding how texts were composed collaboratively in scriptoria. Third, semantic analysis engines cross-reference transcribe text against the entire digitized corpus, identifying connections invisible to human researchers. A single historian might spend a lifetime studying papal correspondence with French monarchs. An AI can simultaneously analyze that correspondence alongside financial records from the apostolic chamber, personnel files of Vatican diplomats, weather records from the period affecting travel and communication speeds, and even astronomical events mentioned in marginalia. In 2023, this capability produced a discovery that rewrote understanding of Renaissance economics. Dr. Sofia Ricci of Bocconi University was studying trade patterns between Rome and Florence when the archive's AI suggested connections she had never considered. By analyzing 17,000 letters between papal bankers and Medici agents across 3 centuries, the system identified a pattern of currency arbitrage exploiting minute differences in exchange rates between Roman scudi, Venetian ducats, and Byzantine hyperpora. The Medici didn't rise to power primarily through textile manufacturing or art patronage, as textbooks claimed, but through sophisticated financial engineering that moved capital across jurisdictions faster than information about exchange rate fluctuations could travel. The evidence had sat in Box 44B of the Apostolic Chamber Archives since 1489, invisible to historians who lacked the capacity to cross-reference thousands of financial documents against diplomatic correspondence. The AI found the pattern in 47 seconds. This is not the replacement of human historians. It is their augmentation, giving researchers superpowers of pattern recognition while preserving human judgment for interpretation. The Vatican's approach to this technology reflects profound ethical caution. Unlike commercial AI projects trained on scraped internet data without consent, the archive systems train only on documents whose creators have been dead for centuries, raising no privacy concerns. Unlike platforms that optimize for engagement or profit, the archive's AI optimizes for accuracy and scholarly utility. And unlike systems that obscure their reasoning behind black box algorithms, the Vatican requires all AI suggestions to be accompanied by transparent evidence trails showing exactly which documents and passages informed each connection. A researcher receiving an AI suggestion that Pope Alexander VI 1493 correspondence with Portuguese navigators correlates with unusual expenditures in the Apostolic Chamber can click through to see the specific letters, the specific financial entries, and the statistical confidence level of the correlation. This transparency ensures that AI serves as a research assistant rather than an oracle, suggesting avenues for investigation while leaving final interpretation to human scholars. The democratization potential of this project is staggering. Once complete, any student with an internet connection, whether in Nairobi or New Delhi, whether at an elite university or a rural community college, will have the same access to primary sources that previously required travel to Rome, fluency in Latin and paleography, and months of archival training. This does not eliminate the value of physical archive visits. There remains something irreplaceable about holding a document created 8 centuries ago, feeling its texture, smelling its age, seeing the wormholes and stains that constitute its biography. But it removes barriers of geography, wealth, and institutional privilege that have historically restricted archival access to a narrow elite. The archives director, Bishop Sergio Pagano, articulated this vision in a 2022 address. For centuries, archives served power by controlling access to memory. The powerful decided who could read the past and therefore who could shape the future. Our mission now is to invert that relationship. We do not own these documents. We steward them on behalf of all humanity. Digital access is not a threat to our relevance. It is the fulfillment of our purpose. When a girl in a village in Bangladesh can study the same papal letters as a professor at Harvard, we have succeeded not as an institution but as guardians of human memory. This vision faces practical challenges. Complete digitization at current rates will take approximately 80 years, longer than the career of any archivist currently working. Storage requirements are astronomical. High-resolution multispectral images of fragile documents require approximately 2 gigabytes per page. With an estimated 200 million pages in the archive, total storage needs approach 400 petabytes, equivalent to 200 million high-definition movies. Preservation of digital files presents its own challenges. File formats become obsolete, storage media degrade, and the energy requirements for maintaining such vast digital repositories raise environmental concerns. The Vatican's solution involves redundant storage across 3 geographically dispersed locations: Rome, Switzerland, and Canada, migration to new formats every decade, and participation in the lots of copies keep stuff safe, international preservation network. But the greatest challenge may be philosophical. Can digital surrogates truly replace physical encounter with historical objects? Many archivists argue no, that the materiality of documents matters profoundly. The weight of a parchment charter in your hands communicates authority in ways pixels cannot. The smell of aged paper and leather bindings creates a sensory connection to the past. The physical act of turning a page, feeling its thickness, seeing how it has been repaired over centuries, reveals aspects of the document's history no scan can capture. The archive's approach embraces both realities: digital access for broad democratization, physical access for deep scholarly engagement. Neither replaces the other. Together, They form a complementary ecosystem of memory preservation. And underlying all this technological transformation remains a constant. The archive's fundamental purpose has not changed in 12 centuries. It exists not to control the past but to serve the future. Not to protect power but to preserve truth. Not to hide secrets but to ensure that when humanity needs to remember, when we face moral crises requiring historical perspective, when we must learn from past failures to avoid repeating them, the evidence will be waiting. Not hidden, not distorted, not destroyed, simply preserved with patience and care for those who come after us. This brings us to the most painful ethical dilemma facing not just the Vatican Archives but every repository of human memory in the digital age. Should all documents eventually become public, regardless of consequences? The tension between transparency and human dignity reached a crisis point in 2021 when survivors of clerical sexual abuse demanded immediate, unrestricted access to all Vatican files documenting how bishops handled abuse allegations from 1950 to the present. Their demand was morally compelling. Without full transparency, how can the Church be held accountable? Without seeing the complete record, how can patterns of cover-up be documented and prevented from recurring? The Vatican's response, refusing immediate unrestricted access while offering redacted access to researchers studying systemic patterns, sparked accusations of continued cover-up. But the reality behind closed doors was more complex. The files in question contain not just evidence of institutional failure but the raw, unfiltered trauma of victims. Names of children abused, medical records documenting psychological damage, transcripts of therapy sessions where survivors recounted abuse in graphic detail, letters from parents pleading for help, internal church memoranda evaluating whether victims were credible or troubled. Publishing these documents without consent would constitute a second violation. Re-traumatizing victims who shared their stories in confidence, exposing children, some still minors, to public identification, and potentially triggering psychological crises in survivors who believed their testimony would remain confidential. One survivor, speaking anonymously to researchers, articulated the dilemma: "I want accountability. I want the bishops who protected predators to face justice. But I also want to live my life without strangers recognizing me as that abuse victim from the Vatican files. I testified believing my identity would be protected. To have that promise broken now would feel like the Church abusing me all over again, this time in the name of transparency." This is not a hypothetical concern. When Pennsylvania released its grand jury report on clerical abuse in 2018, several victims reported receiving harassing messages from strangers who identified them from contextual clues in the redacted documents. Some lost jobs when employers connected their identities to the abuse allegations. Others faced social ostracism in tight-knit Catholic communities. Transparency without protection can become violence disguised as virtue. The Vatican's compromise solution, redacted access, allows researchers to study cover-up patterns without seeing victim identities. Statistical analysis can reveal that Bishop X consistently transferred accused priests rather than reporting them to police. Researchers can document that certain dioceses developed protocols for handling allegations that prioritized institutional reputation over child safety. But the names of victims, the graphic details of abuse, the psychological evaluations, all remain redacted to protect human dignity. Is this perfect? No. Does it slow accountability? Possibly. But it acknowledges a truth that pure transparency advocates often ignore. Archives contain not just facts but human beings. People who suffered, who trusted institutions with their pain, who deserve protection even as institutions face accountability. This tension between truth and mercy, between historical record and human dignity, represents the archive's deepest ethical challenge. There are no easy answers. Every choice involves trade-offs. Full transparency risks re-victimization. Complete secrecy enables continued cover-up. The middle path of redacted access satisfies no one completely but may represent the least harmful option available. And this uncomfortable compromise reflects a deeper truth about historical memory itself. It is never neutral. Every decision about what to preserve, how to catalog it, who can access it, and under what conditions represents a moral choice with real-world consequences for living human beings. Archives are not passive warehouses. They are active participants in justice, healing, and historical understanding. Their power demands humility, their responsibility demands wisdom, and their ultimate purpose must always be service, to truth, yes, but also to the human beings whose stories fill their shelves. After years of immersion in these documents, historians report a profound psychological transformation that reshapes their understanding of truth itself. They stop searching for the truth, the singular, capital T truth that resolves all ambiguity, and begin mapping truths in the plural. Layered, contradictory, context-dependent perspectives that coexist without resolution. The archive reveals this reality with brutal clarity. Open two folders documenting the same historical event, the 1571 Battle of Lepanto, for instance, and you encounter irreconcilable narratives. The Spanish ambassador's report to Philip II describes a glorious Christian victory ordained by divine providence, with vivid accounts of Ottoman ships exploding under cannon fire, enemy sailors leaping into the sea to escape certain death, the banner of the Holy League flying triumphantly over captured galleys. The tone is exultant, the language saturated with religious certainty. God had spoken through cannon smoke, and Christendom had prevailed. Open the Ottoman courier's intercepted letter, preserved because Vatican intelligence intercepted and copied it before allowing it to continue to Constantinople, and you encounter a different reality entirely. The Ottoman commander describes a tactical withdrawal preserving the core of the fleet, minimizing losses while inflicting significant damage on the Christian alliance. He notes that adverse winds prevented full deployment of Ottoman firepower, that several galleys were lost not to enemy action but to navigational errors in the chaos of battle, that the strategic objective of testing Christian naval coordination was achieved regardless of tactical outcome. Both documents are authentic. Both were written by eyewitnesses convinced of their own accuracy. Both contain verifiable facts mixed with interpretation. Neither is the truth. Both are truths partial, perspectival, shaped by the writer's position, interests, and worldview. This multiplicity does not lead to relativism, the lazy conclusion that all perspectives are equally valid. The archive contains plenty of demonstrable falsehoods, forgeries created to claim land rights, financial records altered to hide embezzlement, letters forged to discredit political rivals. These can be identified through material analysis, ink composition, parchment dating, contextual inconsistencies, and cross-referencing with other documents. The archive distinguishes between lies and perspectives. Lies can be disproven. Perspectives can only be understood within their context. The deeper lesson is that historical truth resembles a hologram. Every angle reveals a different image, yet all angles belong to the same underlying reality. No single document contains the complete picture. Only by holding multiple perspectives in tension, without forcing premature resolution, can we approach something resembling historical understanding. This capacity for comfortable uncertainty represents the archive's greatest gift to researchers. Modern culture trains us to seek quick resolution, to label historical figures as heroes or villains, to declare institutions righteous or corrupt, to extract simple moral lessons from complex events. The archive resists this impulse. It presents Pope Urban VIII both as the patron who protected Galileo for decades and as the Pope who ultimately permitted his trial, both as a brilliant intellectual who wrote poetry in Latin and as a nepotist who enriched his family at church expense, both as a defender of orthodoxy in an age of religious warfare and as a man whose rigidity may have delayed scientific progress for generations. To hold all these truths simultaneously, to refuse the comfort of moral simplification, requires emotional maturity most of us lack. It requires accepting that the people who shaped history were neither monsters nor saints, but human beings navigating impossible complexities with limited information and flawed judgment. And this realization inevitably turns inward. If historical figures deserve this nuanced understanding, what about our contemporaries? What about ourselves? The archive's ultimate secret is not about the past at all. It is a mirror held up to the present, asking each visitor, when your documents are opened centuries from now, your emails, your texts, your private journals, will future historians find a person of simple moral clarity or complex contradiction? Will they see someone who recognized the moral challenges of their era and acted with courage? Or someone who recognized those challenges and chose comfort, safety, institutional loyalty over principle? The Crusaders believed they served God. The Inquisitors believed they saved souls. The colonial missionaries believed they brought civilization. All acted in good faith by the standards of their time. All caused suffering that future generations would condemn. All would be horrified to learn how history judges them. This is the humility the archive teaches. We too will be judged by standards we cannot yet imagine. The moral certainties that feel absolute to us today, our views on justice, equality, human rights, will appear partial, incomplete, perhaps even barbaric to our descendants. They will find our blind spots with the same ease we find the blind spots of medieval popes. They will marvel at our capacity to condemn obvious evils while remaining blind to evils embedded in our own institutions. They will ask the same question we ask of Pius XII. How could they know what was happening and not act? The archive does not promise we will be judged kindly. It promises only that we will be judged honestly if its documents survive, and that honesty, however painful, is preferable to the comfort of forgotten sin. This is why memory matters. Not because it makes us feel good about our ancestors, not because it provides simple heroes to emulate, but because it ensures that failure is not erased, that suffering is not forgotten, that future generations can learn from our mistakes rather than repeating them. The covenant of the archive is not between the Vatican and historians. It is between the past and the future. It is a promise that someone, somewhere, is preserving the evidence, not to shame us, but to save those who come after us from having to learn these lessons anew through fresh suffering. Paper outlives power. Ink outlives ideology. And truth, however fragmented, however painful, however inconvenient, deserves to be preserved not for the powerful who created it, but for the vulnerable who must learn from it. We live now in an age of manufactured memory, where the very concept of shared historical truth is dissolving before our eyes. Deepfake technology can generate photorealistic video of historical figures speaking words they never uttered. Social media algorithms feed us historical narratives that confirm our existing biases while filtering out contradictory evidence. Political movements across the ideological spectrum increasingly base their platforms on events that never happened or have been grotesquely distorted. In this epistemological chaos, the Vatican Archives stand as an antidote. Not because they are infallible, they contain errors, biases, and omissions like any human creation, but because they are stubbornly, irreducibly physical. You cannot deepfake parchment. You cannot algorithmically generate the wormholes created by actual insects burrowing through paper in the 14th century. You cannot digitally replicate the water stain from the 1450 Tiber flood that left its mark on thousands of documents stored in ground floor rooms. You cannot fake the candle wax drip frozen in time on a 16th century scribe's marginal note, captured mid-fall as he worked past midnight by guttering flame. These documents bear the scars of time itself. Their materiality is their authenticity. In a world drowning in digital lies, this physicality becomes radical. When a researcher holds a letter signed by Michelangelo in 1542, requesting payment for the Sistine Chapel scaffolding repairs, they are not interacting with a representation. They are touching the same paper Michelangelo touched. They are seeing the same ink he applied. They are sharing a moment across 5 centuries of human experience. This continuity of material witness, this unbroken chain of physical evidence stretching back to the early Middle Ages, provides an anchor in our sea of digital disinformation. It whispers a radical truth. Some things really happened. Some words were really written. Some choices were really made, and we must live with their consequences. The archive does not offer escape from complexity. It does not provide the comfort of simple narratives. It does not validate our preferred version of history. What it offers is far more valuable: evidence. Not all evidence, not perfectly preserved evidence, but enough evidence to prevent total historical amnesia. Enough to ensure that when someone claims the Holocaust never happened, there exist documents, letters from victims, deportation orders signed by officials, internal memoranda calculating train capacities, that can be physically examined, materially verified, historically contextualized. Enough to ensure that when someone claims the church has always been corrupt, there also exist documents, letters from priests sheltering refugees at personal risk, financial records showing charitable distributions during famines, Internal reforms initiated by popes confronting institutional failure that complicate the narrative without excusing the failures. The archive's genius is its refusal to simplify. It preserves both the sublime and the monstrous, both the heroic and the cowardly, both the wise and the foolish, because that is what humanity contains. To preserve only the admirable would be propaganda. To preserve only the shameful would be nihilism. To preserve everything, without judgment, without censorship, without erasure, is an act of radical faith in future generations' capacity to discern wisdom from folly. This is the real secret the Vatican Archives protect. Not a conspiracy, not a cover-up, not hidden knowledge about Antarctica or aliens or ancient civilizations. What exists in these vaults is far more valuable. 120,000 archival boxes containing the unvarnished record of humans striving across 12 centuries. Popes who failed spectacularly and popes who rose to moral greatness, sometimes the same pope on different days. Saints who doubted their faith in dark nights of the soul. Diplomats who prevented wars through patient negotiation. Bureaucrats who enabled genocide through meticulous record-keeping of deportations. Ordinary people writing desperate letters to distant popes hoping someone in power might care enough to intervene. A Jewish family in Amsterdam in 1942 pleading for help finding hiding places. An enslaved African in Brazil in 1783 petitioning for baptism as a step toward legal personhood. A famine victim in Ireland in 1847 begging the Vatican to pressure British authorities for food aid. These letters rarely changed history. Most received form letter responses or no reply at all. Yet they were preserved, not because they mattered to power, but because they mattered to memory. Because someday someone might need to know that ordinary people cried out in their suffering, that they were not silent, that they demanded witness even when they received no help. That is the covenant of the archive, to bear witness even when witness changes nothing, to preserve memory even when memory brings no justice, to ensure that the victims of history are not erased twice, first by their suffering, then by forgetting. So no, there is no map of ice-free Antarctica hidden in these vaults. No treaties with extraterrestrial beings. No proof of a 2,000-year conspiracy to control humanity. What does exist is far more extraordinary. The complete, unbroken memory of Western civilization's longest-lasting institution, preserved with a fidelity unmatched anywhere on Earth. And within that memory lies not secrets to expose but wisdom to receive, if we have the humility to listen. The archives are open, not completely, not instantly, but progressively, responsibly, with respect for both truth and human dignity. The question is not what they hide. The question is whether we are ready to read, not as prosecutors seeking evidence for predetermined verdicts, not as devotees seeking confirmation of cherished beliefs, but as human beings humble enough to learn from the triumphs and failures of those who came before us. Over 2 million documents from the Vatican Archives are now digitized and freely accessible through the Archives online portal. Millions more await digitization. None require conspiracy to appreciate. None demand belief in hidden truths. All require only curiosity, the ancient human impulse to understand where we came from so we might discern where we are going, and the courage to face what we find there, not as villains or heroes, but as human beings trying, failing, and sometimes succeeding to build a world worth remembering. That is the real secret, and it was never hidden at all. It has been waiting patiently on shelves of oak and stone, in boxes of acid-free cardboard, in the careful hands of archivists who understand their work not as guarding secrets, but as keeping faith with the future. Paper outlives empires. Ink outlives ideology, and memory, preserved with patience and care, outlives even time itself. The archives are open. The question is not what they hide. The question is, are we ready to read? Are we ready to learn? Are we ready to remember? The documents are waiting, not in darkness, not behind locked doors, not as secrets to be exposed, but as gifts to be received. Fragile, imperfect, human gifts carrying the accumulated wisdom and folly of 12 centuries. All they ask is that we approach them with humility, that we listen before we judge, that we remember before we forget, that we honor the past not by worshiping it or condemning it, but by learning from it, so that our own documents, when opened centuries from now, might tell a story worthy of preservation. Not a story of perfection, not a story of purity, but a story of people who faced their moment of moral testing and chose, however imperfectly, to stand with the vulnerable rather than the powerful, with truth rather than convenience, with memory rather than forgetting. That is the covenant of the archive. Not secrecy, not conspiracy, but memory itself, preserved not for the powerful who created it, but for the future generations who must learn from it. The archives are open. The question is not what they hide. The question is what we will do with what they reveal about ourselves.
Копировать. Спроси Корн. Объяснить. Перевести Руру.